Hey everyone, welcome back to the channel. Today, we're diving into a must-read book for any aspiring trader, How to Day Trade for a Living by Andrew Aziz. If you're looking to make a career out of day trading or simply want to understand the fundamentals of successful trading, this book is your perfect guide. In this video, I'll be walking you through the entire book, chapter by chapter, and breaking down the key points and strategies that will help you get started in day trading. Here's a quick rundown of what we'll be covering. Chapter 1, Introduction, 2020 Hindsight. Chapter 2, How Day Trading Works, Day Trading versus Swing Trading, Buying Long, Selling Short, Retail versus Institutional Traders, High Frequency Trading, HFT, Trade the Best, Leave the Rest. Chapter 3, Risk and Account Management, 3-Step Risk Management, Trading Psychology. Chapter 4, How to Find Stocks for Trades, Stocks in Play, Float and Market Cap, Pre-Market Gappers, Real-Time Intraday Scans, Planning the Trade Based on Scanners. Chapter 5, Tools and Platforms, What Broker to Use, Trade for Proprietary Trading Firms, Trading Platform, Real-Time Market Data, NASDAQ Level 2 and Bid-Ask, Indicators on My Charts, Buy and Sell Orders, Hotkeys, Watch List and Scanners, Community of Traders. Chapter 6, Introduction to Candlesticks, Price Action and Mass Psychology, Bullish Candlesticks, Bearish Candlesticks, Indecision Candlesticks, Candlestick Patterns. Chapter 7, Important Day Trading Strategies, Trade Management and Position Sizing. Strategy 1, ABCD Pattern. Strategy 2, Bull Flag Momentum. Strategies 3 and 4, Reversal Trading. Strategy 5, Moving Average Trend Trading. Strategy 6, VWAP Trading. Strategy 7, Support or Resistance Trading. Strategy 8, Red to Green Trading. Strategy 9, Opening Range Breakouts, Other Trading Strategies, Develop Your Own Strategy, Trading Based on the Time of Day. Chapter 8, Step by Step to a Successful Trade, Building a Watch List, Trading Plan, Entry, Exit, and Stop Loss. Execution, How did I do them? Chapter 9, Case Study of a Newly Successful Trader, Insight from a Newly Successful Trader, Early Trading Education, Beginning to Day Trade, Hitting My Low Point, Risk the same amount of money per trade. Risk a small amount of money per trade. Until you are consistent. Use hard stops to exit trades. Focus on a single strategy until you master it. Listen to experienced traders. Step-by-step examination of a trade. Chapter 10, Next Steps for Beginner Traders. The 7 Essentials for Day Trading. Do not be a gambler. Be a trader. Plan your trading business. Journaling your trades. Trading and climbing. Final words, Andrew's 10 Rules of Day Trading. If you're serious about day trading, this book is packed with valuable insights, strategies, and practical advice that can help take your trading skills to the next level. If you're excited to learn more, make sure to like, share, and subscribe to the channel for more trading tips and content. And don't forget to hit the bell icon so you never miss out on future videos. Now let's jump into the world of day trading with Andrew Aziz, How to Day Trade for a Living. Chapter 1, Introduction, 2020 Hindsight. Hey there, welcome to the first chapter of How to Day Trade for a Living. Let's talk about something we all do, looking back and reflecting. In this chapter, Andrew Aziz kicks things off with a look back at 2020, a year full of wild market movements. But it's not just about the ups and downs of the stock market. It's about what we can learn from them. 2020 wasn't just another year. It was a year of surprises, volatility, and big opportunities. For many traders, it was a roller coaster. But here's the thing. While it's easy to look at those big swings in the market and think, I should have seen that coming, the truth is, no one really can. What makes a successful trader isn't knowing what's going to happen, but being able to adjust and adapt to whatever comes your way. Aziz uses 2020 hindsight as a metaphor. It's easy to see things clearly after they've happened, right? Like looking back at a trade and thinking, oh, I should have done this instead. But the real skill comes from learning how to handle those situations while they're happening. How do you react in real time when the market's moving fast? How do you make smart decisions when you don't have the luxury of hindsight? The key takeaway here is that trading isn't just about spotting the next big trend or making that perfect trade. It's about being flexible and adapting your strategy as the market changes. The stock market is constantly evolving, and so should you as a trader. Sticking to the same old methods that worked in the past can leave you behind, but staying open to new strategies and adjusting when things change, that's how you grow as a trader. Aziz reminds us, every trade, win or lose, is a learning experience. Don't just focus on the money, focus on getting better each time. The more you reflect, the more you'll improve your trading strategy. And in the long run, that's what will set you up for success. So, remember, don't just wait for perfect opportunities. Learn how to spot them in the moment and adjust as needed. It's all about staying adaptable and continuously improving. Chapter 2, How Day Trading Works, Day Trading versus Swing Trading. All right, let's dive into Chapter 2, where we're going to clear up some confusion between two major trading styles, day trading and swing trading. You might have heard of both, but what's the real difference? Let's break it down. First, day trading. It's all about quick moves. As a day trader, you buy and sell stocks within the same day. You're in and out of trades fast, sometimes within minutes or hours, never holding positions overnight. The goal? Catch small price movements throughout the day and profit from them. Now, this sounds exciting, right? But here's the catch. Day trading involves a lot of focus and quick decision making. You need to be glued to your screen, watching the market move in real time. The reward can be great, but so is the risk. With the market moving so fast, a single wrong decision can wipe out your gains. That's why risk management is key in day trading. On the flip side, we have swing trading. This style is more relaxed in terms of timing. As a swing trader, you hold your positions for several days or even weeks, aiming to capture bigger price swings. So it's less about quick decisions and more about spotting trends that will play out over time. The risk and reward can be higher here because you're holding positions longer, but also the pressure isn't as intense as with day trading. You don't need to monitor the markets every minute, which can be a huge relief for some traders. So, what's the difference? Time frame. Day traders work in short time frames, closing all positions by the end of the day. Swing traders hold positions for a few days to weeks. Risk and reward. Day trading can be more intense, with quicker rewards but also faster losses. Swing trading, on the other hand, can offer larger rewards since you're capturing longer price movements, but the risk is also spread out over more time. Lifestyle. Day trading requires constant attention, so it's great for people who thrive in fast-paced environments. Swing trading is for those who prefer less screen time and can be more patient with their trades. In the end, which style suits you depends on your personality, risk tolerance, and how much time you want to commit to trading. Both can be profitable, but each comes with its own set of challenges. The key is to figure out which one works best for you, then stick to it while continuously improving your skills. Let's talk about two crucial concepts every trader needs to understand: buying long and selling short. These are the core ways traders profit in both rising and falling markets. Sound interesting? Let's break it down. First up, buying long. This is what most people think of when they hear about investing. It's straightforward. You buy a stock or any asset with the expectation that its price will go up. In simple terms, you're going long because you believe the market will rise. Here's how it works. 1. You buy an asset, let's say a stock, at a certain price. 2. You hold on to it while its value increases. 3. Once the price has risen enough, you sell it at a higher price and pocket the profit. For example, if you buy a stock at $50 and sell it later at $70, your profit would be $20 per share. Buying long works well in bull markets, where prices are generally moving upwards. But here's where it gets interesting. Selling short. This is the opposite of buying long and can be a bit tricky, but don't worry, we'll keep it simple. Selling short allows traders to profit from falling markets. In a short sale, you don't actually own the asset at first. Here's how it works. 1. You borrow shares of a stock from someone else, typically through your broker. 2. You sell the borrowed shares at the current market price. 3. When the price drops, which you're betting it will, you buy back the shares at the lower price. 4. You return the shares to the lender and keep the difference as profit. For example, if you borrow and sell a stock at $100 and later buy it back at $70, your profit would be $30 per share. Selling short is a way to profit in bear markets where prices are falling. But, and this is important, short selling carries more risk than buying long. Why? Because there's no limit to how high a stock can rise, so your losses can be much bigger if the price goes up instead of down. With buying long, the most you can lose is what you've invested. But with short selling, your potential loss is unlimited if the price keeps rising. In summary, buying long is all about betting the market will go up. You buy low and sell high. Selling short is about betting the market will go down. You sell high and buy low. Each strategy has its place, depending on the market conditions and your risk tolerance. Day traders and swing traders use both, depending on whether they expect prices to rise or fall. So whether you're going long or selling short, remember these two strategies are essential tools for profiting in any market environment, whether it's up, down, or sideways. Retail versus institutional traders, the key differences between individual traders and big players. Hey everyone, in this part of the book, we're diving into a key topic, the difference between retail traders and institutional traders. You might have heard these terms thrown around before, but let's break them down in simple terms and see how they operate differently in the markets. First up, retail traders. These are the individual traders, the everyday people like you and me, who trade with their own money. Retail traders are typically smaller players in the market, and they trade through personal brokerage accounts. What sets retail traders apart is that they usually don't have the massive resources or the big tools that institutional traders use. They rely on their own research, trading platforms, and analysis. Advantages of retail traders. Flexibility. Retail traders can make quick decisions, move in and out of trades without restrictions, and easily trade on smaller timeframes. Personal control. You control your trades. There's no big corporation or committee telling you what to do. You make your own decisions. Lower barriers to entry. With online trading platforms and low commission fees, getting started as a retail trader is easier than ever. However, retail traders also face some challenges. Limited capital. Since they trade with their own funds, retail traders usually don't have the huge capital that big institutions do. Limited access to information. While there's plenty of data available to everyone, institutional traders often have access to more advanced, real-time, and in-depth information. Now let's talk about institutional traders. These are the big players in the market. Think hedge funds, banks, mutual funds, pension funds, and large investment firms. They have huge amounts of money to trade with, often in the billions. Because of this, they can make moves that significantly impact the markets. Advantages of institutional traders. Massive capital. With billions of dollars at their disposal, institutional traders can move markets more easily. Their trades can drive prices up or down, especially in less liquid markets. Advanced tools and research. They have access to cutting-edge trading algorithms, advanced market analysis tools, and real-time information that retail traders just don't have. Lower transaction costs. Because they trade in huge volumes, institutions often pay lower commissions and transaction fees, allowing them to execute more trades for less cost. But institutional traders also face their own set of challenges. Slower decision-making. Unlike retail traders who can act quickly, institutions often have to go through layers of approval and decision-making processes. This can sometimes cause delays in executing trades. Market impact. When institutional traders make big moves, it can lead to sharp price swings. If an institution wants to buy or sell a large number of shares, they might have to do it in pieces to avoid causing a massive market disruption. So, the big differences here are about size, speed, and resources. Retail traders are typically smaller, more nimble, and have more flexibility, but less capital and fewer resources. Institutional traders have large amounts of capital, advanced tools, and research, but they also face challenges like slower decision-making and market impact. In the end, both types of traders play important roles in the market. Retail traders can take advantage of their flexibility and lower barriers to entry, while institutional traders use their power and resources to move the markets and make larger trades. The key for anyone starting out is understanding how these big players operate and using that knowledge to your advantage. High frequency trading, HFT, how algorithm-based trading impacts the markets. All right, let's talk about something that's become a huge part of modern trading. High frequency trading, or HFT. You've probably heard the term before, but what does it actually mean, and how does it affect the markets? Let's break it down in a simple, engaging way. High frequency trading is a type of algorithm-based trading. In simple terms, it's when computers and algorithms take the lead in buying and selling assets at lightning speed. These algorithms are designed to process huge amounts of market data and execute trades in fractions of a second. We're talking microseconds, way faster than any human could ever react. How does it work? HFT uses powerful computers to look for patterns and opportunities in the market. The goal is to make tiny profits from each trade. But because these trades happen so fast and in such large numbers, those tiny profits can add up to massive amounts over time. For example, a high-frequency trading algorithm might spot an opportunity to buy a stock at $50.01 and sell it at $50.02 within milliseconds. It doesn't sound like much, right? But when you're executing thousands or even millions of these trades every day, it adds up quickly. The impact on the market. Now, let's talk about how this affects the market. HFT has a big impact on how trading works, especially when it comes to liquidity. Liquidity is how easily you can buy or sell something without drastically affecting its price. Thanks to HFT, the markets are often more liquid, meaning there's usually more buying and selling going on, which helps keep prices stable. But here's where it gets controversial. Some people argue that HFT can create unfair advantages. Why? Because HFT firms have access to faster technology and better resources than regular traders. This can lead to market manipulation in some cases, where these firms might use their speed to front-run regular traders, getting ahead of them on trades and making profits at their expense. Is it good or bad? Well, it's a bit of a mixed bag. On one hand, HFT helps make markets more efficient. It increases liquidity, which means it's easier for everyone to buy and sell assets. On the other hand, it can also make the playing field uneven. Retail traders, who don't have access to the same speed or technology, can find themselves at a disadvantage when competing against HFT firms. And then there's the issue of flash crashes. These are sudden, drastic drops in the market that can happen in the blink of an eye. While HFT can help stabilize prices most of the time, it's also been blamed for some of these sudden crashes because algorithms can react too quickly to a change in market conditions, triggering a chain reaction that spirals out of control. The bottom line. So high-frequency trading is all about computers doing the trading, executing thousands of trades in microseconds to capture small profits that add up. It can bring more liquidity and make markets more efficient, but it also raises concerns about fairness, market manipulation, and the potential for unexpected crashes. In short, while HFT is a powerful tool, it's something that comes with both benefits and risks. Whether it's good or bad really depends on how it's used and whether the market can keep up with the technology that's driving it. Trade the best, leave the rest. Focus on high-probability trades. All right, now let's talk about a key strategy that can really level up your trading game. Trade the best, leave the rest. This simple principle is all about focusing your energy and effort only on high-probability trades, the trades that have the best chance of success. It's about being selective rather than trading every opportunity that comes your way. You see, as a trader, you don't need to take every trade that looks good on the surface. In fact, most of the time, those quick, impulsive trades won't give you the returns you're looking for. Instead, successful traders focus on the trades that align with a strong set of criteria and give them the highest odds of success. The goal isn't to make tons of trades, but to make smart trades, and that comes down to quality over quantity. Why focus on high-probability trades? Let's break it down. A high-probability trade is one where the setup is clear, your risk management is solid, and the reward potential is worth it. These are the trades where the odds are stacked in your favor. But how do you know which trades have the best chance of success? It all starts with patience. The key here is to wait for the market to line up perfectly before you jump in. You're looking for clear signals that align with your strategy, whether that's a certain chart pattern, a specific indicator, or a trend that's been developing. If the setup isn't perfect, it's better to skip the trade and wait for a better opportunity. The power of selectivity. Now let's talk about the power of selectivity. As tempting as it might be to jump into every trade you see, successful traders know that being picky actually improves their chances of making money. Instead of spreading yourself too thin, they focus on the trades that fit their strategy and have the highest probability of working out. This doesn't mean you're just sitting around doing nothing all day. You'll still be watching the market closely, looking for those high probability setups. But the key is being patient and only taking trades that have clear potential to move in your favor. As you get better at identifying these setups, you'll see that your win rate goes up and your losses go down. Quality over quantity. Remember this, the best traders don't need to make hundreds of trades to be successful. They focus on the best opportunities, not the most opportunities. So instead of stressing about filling your day with trades, focus on finding those rare, high-probability ones that give you the best chance to win. In the long run, fewer, smarter trades can make all the difference. Avoiding FOMO, fear of missing out. One common mistake new traders make is chasing every trade out of the fear that they'll miss out. This is called FOMO. It's easy to get caught up in the excitement of the market, but remember, there's always another trade coming. By sticking to your strategy and waiting for the best setups, you're actually in control. The takeaway. So what's the big lesson here? Don't try to trade every opportunity you see. Instead, focus on the high probability trades that align with your strategy and offer solid risk to reward. Be patient, stay disciplined, and only pull the trigger when the setup is right. That's how you build a successful trading career, by trading the best and leaving the rest. Chapter 3, Risk and Account Management, 3-Step Risk Management. All right, let's dive into Chapter 3, where we're going to talk about something that can make or break your trading success, risk and account management. If you want to be a successful trader, managing risk is absolutely crucial. Without it, even the best trades can lead to massive losses. So today we'll be focusing on a 3-step risk management process that will help you protect your capital and make more informed decisions. Let's break it down step by step. Step 1, risk per trade. The first step is about deciding how much of your account you're willing to risk on a single trade. And we're talking about percentage, not dollars. Most traders recommend risking no more than 1 to 2% of your total account balance on each trade. This is a smart approach because it allows you to take losses without blowing up your entire account. For example, let's say you have a $10,000 trading account. If you decide to risk 1% per trade, that means your maximum loss per trade is $100. That doesn't sound like much, right? But when you're only risking small amounts on each trade, you can survive a series of losses and still have plenty of capital left to keep trading. The key here is to always calculate your risk before entering a trade. Never just guess how much you're willing to lose. By using this approach, you're ensuring that even a streak of losing trades won't completely wipe out your account. Step 2, stop-loss orders. The second step is to always use stop-loss orders. A stop-loss is a preset order to sell a stock if its price falls to a certain level. This is a safety net that ensures your losses are limited. You'll set the stop-loss based on your risk tolerance from step 1. For example, if your risk per trade is $100, you set a stop-loss level where, if the price moves against you, you'll only lose that $100, nothing more. This helps you control the amount of risk you're taking on each trade, making sure that you don't lose more than you're willing to. Setting your stop-loss is just as important as choosing which stock to buy. Never enter a trade without a stop-loss. It's like a safety belt in a car. It protects you when things go wrong. Step 3, position sizing. The third step is all about position sizing, or in simple terms, determining how much of a stock you should buy based on your risk level and stop loss. Your position size is directly tied to how much capital you're willing to risk on each trade. Let's break it down. If you're willing to risk $100 on a trade and your stop loss is $1 per share, you'll buy 100 shares. Here's the math. You're risking $100. Stop loss is $1 per share. Therefore, you buy 100 shares. 100 shares at $1 stop loss equals $100 risk. Position sizing ensures that you're not overexposing yourself on any one trade. This way, even if your stop loss gets triggered, your overall risk stays in line with what you're comfortable losing. By using position sizing, you're making sure your capital is properly allocated and protected. It's about balancing the potential for profit with your risk tolerance. Putting it all together. To wrap it up, the 3-step risk management process is all about controlling your risk before you even make a trade. Here's the recap. 1. Risk per trade. Limit your risk to 1 to 2% of your account balance on each trade. 2. Stop loss orders. Use stop loss orders to define and control your losses. 3. Position sizing. Calculate how much you should buy based on your risk level and stop loss. By following these steps, you're giving yourself the best chance to stay in the game for the long term. Remember, trading isn't about winning every time. It's about managing risk and making sure that when you lose, it's never more than you can handle. With good risk management, you can protect your account, build your confidence, and grow your trading skills over time. Trading psychology, mastering the mental game of trading. Hey everyone, now let's talk about something that's just as important as your trading strategy, and that's trading psychology. A lot of traders focus on the technical stuff, chart patterns, indicators, market trends. But the real difference between a successful trader and someone who struggles often comes down to their mindset. Yes, your mental game is crucial. The importance of mental discipline. Trading is a high-pressure activity, and it can be really emotional. Whether you're winning or losing, the emotional ups and downs can mess with your decision-making. That's why mental discipline is so important. You need to stay calm and focused, no matter what happens in the market. If you let your emotions take over, you're more likely to make impulsive decisions that can lead to losses. Emotional roller coaster. Let's face it, trading can be an emotional roller coaster. When you're winning, it feels great, right? But what happens when things go wrong? That's where things can get tricky. Traders can experience emotions like fear, greed, and frustration, especially when they face losses or miss out on a trade. Fear. The fear of losing money can sometimes paralyze you. You might hesitate to pull the trigger on a trade or close a losing position too early, just to avoid pain. But that's where having a clear strategy and sticking to your risk management comes in handy. Fear should never drive your decisions. Greed. On the flip side, greed can push you to take unnecessary risks. When you're winning, you might start thinking that you can't lose, and that's when you start taking bigger risks. The thing is, greed can cloud your judgment and lead to poor decisions. If you've had a losing streak, frustration can lead you to trade impulsively, trying to get even. But revenge trading is one of the quickest ways to blow up your account. Managing emotions in trading. So how do you deal with these emotions? The first step is acceptance. You have to accept that losses are part of the game. Every trader, no matter how successful, experiences losses. It's how you react to them that makes the difference. If you lose a trade, don't let it affect your next move. Take a deep breath, learn from it, and keep moving forward. Also, develop a routine to keep your emotions in check. This could mean taking breaks, journaling your trades, or doing things outside of trading to help reset your mindset. The more you can control your emotions, the better decisions you'll make. Patience and discipline. Another big part of trading psychology is patience. It's easy to get excited about a trade, especially if you're seeing a stock moving fast. But remember, patience is key. Sometimes the best trades are the ones you don't make. That means waiting for the right setup and not rushing into trades just because you feel like you should be active in the market. And then there's discipline. Having a plan is great, but you also need the discipline to stick to it. If you've set risk management rules or established certain criteria for entering a trade, don't deviate from them. Trading on impulse will likely lead to mistakes. Building confidence. Finally, Building confidence is a huge part of trading psychology. When you stick to your strategy and see positive results, your confidence grows. But remember, confidence doesn't mean overconfidence. It's about trusting your strategy and your process, knowing that you're making calculated decisions, not emotional ones. If you make a mistake, don't dwell on it. Learn from it and move on. Over time, as you become more disciplined, your confidence will naturally grow, and you'll find that you can handle the ups and downs of the market much better. The bottom line: in trading, the market can be unpredictable, but your mindset doesn't have to be. By managing your emotions, being patient, and staying disciplined, you set yourself up for success. Trading psychology is about staying calm, sticking to your plan, and not letting fear, greed, or frustration dictate your moves. Remember, the most successful traders aren't just good with charts, they're good with their minds. Keep that mental game sharp, and you'll be better equipped to handle whatever the market throws at you. Chapter 4, How to Find Stocks for Trades. Stocks in Play. All right, let's get into one of the most important skills for any trader: finding the right stocks to trade. In this part of the book, we're focusing on stocks in play, the ones that are moving, the ones that have high volatility and volume. These are the stocks you want to keep your eye on if you're day trading. But how do you find them? Let's break it down. What does stocks in play mean? When we say stocks in play, we're talking about stocks that are actively moving, the ones that have big price swings and are being heavily traded. These stocks are interesting because they offer opportunities for profit, whether the price is going up or down. Now, how do you spot these stocks? It comes down to two key factors: volatility and volume. Volatility, the power of price movement. First up, volatility. In simple terms, volatility means how much a stock's price moves up and down. The more volatile a stock is, the larger its price swings, which means more opportunities for traders to make profits. But here's the catch: while high volatility can bring big rewards, it also brings bigger risks. That's why you need to be able to spot volatility and decide if the stock fits within your risk tolerance. So, how do you identify volatile stocks? Look for stocks with large price movements in a short period. For example, a stock that moves from $50 to $60 within a few hours is more volatile than a stock that moves from $50 to $52 in the same time. Volume, the lifeblood of day trading. Next up, let's talk about volume. In trading, volume refers to the number of shares being bought and sold. High volume means there's a lot of activity in that stock, and that's a good sign that it's in play. Why? Because high volume indicates that there are many traders involved, which makes it easier to get in and out of trades at the price you want. Imagine a stock with low volume. Let's say only a few thousand shares are being traded. If you try to buy or sell, you might not be able to get the price you want, and you could end up losing money on slippage. But with high volume stocks, you don't have to worry about that as much because there's a lot of liquidity. How to spot stocks in play. So, how do you actually spot stocks with high volatility and volume? The first thing you should do is check the pre-market activity. The stocks that are moving before the market opens are often the ones that will continue to move once the market opens. Pre-market trading is a good indicator of what to focus on during the day. You can also use screeners, tools that help you filter stocks based on specific criteria like volume, volatility, and price movement. Set up filters to identify stocks that are moving big and then dive into the ones that meet your risk and reward criteria. Why volatility and volume matter. Now, why do volatility and volume matter so much? Because they give you the opportunity to trade. A stock with low volatility might seem stable, but it won't give you the price swings you need to make quick profits. On the other hand, stocks with high volatility and high volume offer more chances to make money as they move up and down throughout the day. But remember, just because a stock has high volatility and volume doesn't mean it's a good trade for you. You've got to make sure that the stock fits within your trading strategy. For example, if you're more risk-averse, you might want to avoid extremely volatile stocks and focus on ones that move in a more predictable way. The takeaway. To wrap it up, When you're looking for stocks to trade, focus on those that are in play, the ones with high volatility and volume. These stocks give you the best chances to make quick profits, but always remember to assess the risk before diving in. Use pre-market activity and stock screeners to spot these opportunities, and once you find them, make sure they fit within your overall trading plan. Now that we've talked about identifying stocks with high volatility and volume, let's dive into another important aspect of finding the right stocks: float and market capitalization. These two factors play a big role in how a stock behaves, and understanding them can help you make smarter trading decisions. Let's break it down. What is float? First, let's talk about float. In the simplest terms, float refers to the number of shares of a company that are available for trading in the open market. So when you hear someone say the float of a stock, they're talking about how many shares are actually out there for you and other traders to buy and sell. Now, why does this matter? Well, the smaller the float, the more volatile the stock can be. Why? Because there are fewer shares in circulation. When demand for those shares increases, the price can move up quickly, and that creates opportunities for traders. For example, if a company has a float of only 10 million shares, and a lot of traders suddenly become interested, the price can jump fast because there just aren't that many shares to go around. But if the float is really high, like 100 million shares, then it's harder for demand to have such a big impact on price. So, in short, smaller float equals more volatility, which can be great for traders looking for fast moves. What is market capitalization? Next up, we have market capitalization, or simply market cap. Market cap is the total value of all the shares of a company combined. It's calculated by multiplying the stock price by the total number of outstanding shares. Small cap stocks. These companies have a market cap of less than $2 billion. They tend to be riskier, but can offer huge growth potential. Mid-cap stocks. These are companies with a market cap between $2 billion and $10 billion. They're typically more stable than small caps, but still have room to grow. Large cap stocks. These companies have a market cap over $10 billion. They tend to be more established and stable, but don't have the same explosive growth potential as smaller companies. Market cap helps traders understand the size of a company and gives them a clue about how volatile or stable the stock might be. Smaller companies tend to be more volatile, while larger companies are more stable, but may not offer the same level of quick returns that smaller companies can. How float and market cap affect trading decisions. So, how do float and market cap affect your trading decisions? Here's the key. 1. Float affects volatility. If you're looking for stocks that can make big moves during the day, focus on low float stocks. These stocks can jump in price quickly when there's high demand, but be careful, they can also drop just as fast. For traders who like fast-paced action and are comfortable with risk, low float stocks can be a great opportunity. 2. Market cap tells you about the stock's stability and growth potential. If you're looking for stability, you might prefer large cap stocks because they tend to be less volatile. On the other hand, if you're chasing higher risk and potential rewards, small cap and mid cap stocks might be more appealing since they can grow quickly but also face bigger swings in price. Which one should you choose? The right stock for you really depends on your trading style. Are you a scalper or day trader looking for quick moves? Then low float stocks with high volatility might be your best bet. If you're a swing trader who prefers more stable movements over several days or weeks, large cap stocks might be better suited for your style. Also, diversifying your trades between different market caps can be a smart move. That way, you get the best of both worlds: more stability with large caps and higher potential with small caps. The takeaway. In summary, float and market capitalization are both critical factors to consider when choosing stocks to trade. Float impacts how much a stock can move. Low float equals more volatility. Market cap gives you an idea of the stock's size and potential growth. Small cap equals higher risk, but bigger rewards. Large cap equals more stable with less risk. By understanding both of these factors, you'll be better equipped to choose stocks that align with your trading strategy, risk tolerance, and goals. All right, now let's talk about a super important concept for day traders: pre-market gappers. If you want to find stocks with big potential for the day, pre-market gappers can be a gold mine. So what are they and how do you find them? Let's dive into it. What is a pre-market gap? A pre-market gap happens when a stock experiences a significant price movement before the regular market opens. This can be a gap up or a gap down. Simply put, it's when a stock's price changes dramatically compared to its closing price the previous day. For example, let's say a stock closed at $50 yesterday, but in the pre-market, it jumps to $55. That's a gap up, a price increase before the market opens. On the flip side, if the stock drops to $45 in the pre-market, that's a gap down, a price decrease before the market even opens its doors for the day. Why are pre-market gappers important? So why should you care about these gappers? Pre-market gappers are important because they can indicate big price moves once the market opens. These stocks are usually moving for a reason: news, earnings reports, or other events that traders react to before the market officially opens. For day traders, pre-market gappers can be a great opportunity to catch a strong price move early in the day. If you can identify stocks that are gapping in the pre-market, you can position yourself to capitalize on these big moves as the market opens. How to spot pre-market gappers. Now, how do you find these pre-market movers? It's all about monitoring the pre-market session. The pre-market opens at 4 a.m. and runs until the official market open at 9:30 a.m. EST. This is when a lot of action happens, and it's your chance to catch stocks that are about to make a big move. Here's what you want to look for. 1. Pre-market price movement. Look for stocks that have already made a big move, up or down, before the market opens. You want stocks that are gapping by at least 5 to 10% or more. The bigger the gap, the more potential there might be for a trade. 2. Volume. Keep an eye on the trading volume. It's not just about the price movement, but also how much action is happening in the pre-market. High volume with a big price gap can indicate a strong move when the market opens. A low volume gap might be less reliable, so pay attention to this factor. 3. News or catalysts. A lot of times, these gaps are driven by news. Maybe the company reported earnings, got FDA approval, or there's some other major event. Always check the news or catalyst behind the gap because it gives you context for why the stock is moving. Trading pre-market gappers. So now that you've spotted a potential pre-market gapper, how do you trade it? Here are some key things to remember. Pre-market trends. If a stock is gapping up in the pre-market, watch to see if the trend continues after the market opens. If it does, you can enter the trade and ride the momentum. But if the gap starts to fade or the price reverses, it's time to exit. Wait for confirmation. Don't jump into a trade just because you see a big gap. Wait for confirmation that the stock is following through with the move. Sometimes stocks will gap up or down in the pre-market, but won't continue that trend once the market opens. Risk management. Pre-market moves can be volatile. They can lead to big profits, but they can also go against you quickly. So always use stop losses and keep an eye on market conditions. If the stock starts moving against you, be prepared to get out quickly. The takeaway. In conclusion, pre-market gappers are stocks that have experienced a significant price change before the market officially opens. These gaps can be a signal of opportunity, but they also come with higher risk. To trade pre-market gappers successfully, keep an eye on the price movement, volume, and any news catalysts. And always manage your risk carefully, because pre-market moves can be unpredictable. Now let's talk about a super powerful tool that can make your trading day much easier: real-time intraday scans. These are tools that help you find potential trades during market hours. Basically, they help you spot opportunities on the fly while the market is moving. If you want to be a successful day trader, scanners are something you can't ignore. Let's break it down and see how you can use them effectively. What is an intraday scanner? An intraday scanner is a tool that scans the market in real time, looking for stocks that meet certain criteria. These scanners can track price movements, volume, volatility, and other indicators that show stocks with high potential for day trading. In other words, instead of searching for stocks manually, these scanners automatically pull up stocks that are moving and meet your trading conditions. They're like having your own personal assistant looking for trades for you all day long. How cool is that? How do intraday scanners work? These scanners are set up with filters that help you spot stocks that are active and volatile. For example, you can set the scanner to find stocks that have moved 5% or more in the last hour, or ones with high trading volume. You can also set it to find stocks with big price gaps, either up or down, or stocks that are trending strongly. The key here is to set the scanner based on your trading strategy. If you're looking for fast moves, you'll want a scanner that focuses on volatility. If you prefer more stable stocks, you might filter for consistent uptrends with higher volume. Why are real-time intraday scans important? Here's why scanners are a game changer. They allow you to spot opportunities in real time, which is crucial for day trading. The market moves fast, and you need to be able to act quickly. Without scanners, you're trying to manually search through thousands of stocks while the market is moving, and that's just not practical. By using these scanners, you're letting the technology do the heavy lifting for you. It can scan through hundreds or even thousands of stocks in seconds and pull up the ones that are making big moves. This gives you more time to focus on executing your trades and analyzing the best setups. What to look for with intraday scanners? When using an intraday scanner, there are a few key factors to focus on to find the best trades. 1. Price movement. Set your scanner to look for stocks that have moved a certain percentage during the day. This could be 5 cent, 10 cent, or whatever fits your strategy. Stocks that are moving a lot are usually more volatile, which gives you more chances for profit. 2. Volume. Look for stocks with high trading volume. High volume means there's lots of activity, and that's what you want to see in a stock that you plan to trade. It's easier to get in and out of trades with stocks that have high volume, plus high volume can sometimes signal that the stock has momentum. 3. Gaps and trends. You can filter for stocks that have gapped or down significantly in the pre-market or overnight, or that are showing a strong trend during the trading day. These types of stocks often continue their momentum as the market opens, and you want to be able to ride that wave. Number 4, volatility. If you're looking for a fast-paced trade, set your scanner to find highly volatile stocks. These stocks tend to move a lot during the day, giving you more potential for quick profits. But remember, volatility also means higher risk, so be sure to manage your trades carefully. How to use the scans for trading. Once your scanner has found some potential trades, it's time to take action. But don't just jump in right away. Use the scanner results as a starting point and do some quick analysis before you enter a trade. Here's a simple process to follow. Review the stock's chart. Is the stock trending in the direction you want to trade? Look for patterns that match your strategy. Check for news. Why is the stock moving? If it's because of a big earnings report or some other news, it could have more momentum. Manage your risk. Set stop-loss orders and position sizes based on your strategy. Even if a stock is moving well, don't forget to protect your capital. The takeaway: real-time intraday scans are powerful tools that help you find the trading opportunities during market hours. They save you time by scanning the market for stocks that meet your trading criteria, like price movement, volume, and volatility. By using these scanners, you can spot opportunities quickly and act on them before they pass by. Just remember, scanners are there to help you filter through the noise of the market and find the best setups. But it's up to you to analyze the stock, manage risk, and execute your trades with discipline. All right, so you've got your scanner up and running, and it's giving you a list of stocks that are moving big during the day. But here's the thing: just having the scanner data isn't enough. To become a successful trader, you need to plan your trades based on that data. Let's talk about how you can take scanner results and turn them into actionable trade plans that help you stay disciplined and make the most out of each opportunity. What does it mean to plan a trade? A lot of traders think that planning is just for beginners, but in reality, every professional trader has a solid plan before they even enter a trade. It's the secret to avoiding impulsive decisions and sticking to a strategy that works. When you plan your trade, you're laying out a roadmap for how you'll enter, manage, and exit your trade. This includes setting entry points, stop losses, profit targets, and other key factors that will help guide your decisions. How to plan a trade using scanner data. Now, let's get into the good stuff. How do you actually create a plan based on the scanner results you get? Here's a simple step-by-step process. 1. Scan for opportunities. First, use your scanner to pull up stocks that are showing the right criteria for your trading style. This could be stocks that have moved by a certain percentage, have high volume, or are trending in a specific direction. The scanner helps you identify the best candidates for a trade. 2. Analyze the stock. Once the scanner has given you a list of potential trades, it's time to dive deeper into each stock. Don't just blindly enter a trade based on the scanner result. Look at the stock's chart, check for any news or catalysts, and analyze the stock's overall trend. This step helps you understand whether the stock is in a strong position to continue moving in your favor. Is it in an uptrend or downtrend? Is there any major news driving the price? How volatile is the stock? The more you know about the stock, the better your chances of making a smart decision. 3. Set your entry point. Based on your analysis, determine the best entry point. This is where you plan to enter the trade. It's not just about getting in at any random price, it's about waiting for the right moment. For example, you might decide to enter a trade once the stock breaks above a specific resistance level, or if it shows strong support at a certain price. 4. Set your stop loss. One of the most important parts of planning a trade is setting a stop loss. A stop loss is an order you place with your broker to sell a stock if it hits a certain price, preventing you from losing more than you're willing to risk. Your stop loss should be placed at a level where, if the stock moves against you, you'll exit the trade and cut your losses before things get worse. For example, if you're trading a stock at $50 and you're willing to risk $2 per share, you might set your stop loss at $48. If the stock falls to $48, you exit the trade to protect your capital. 5. Set your profit target. Just as important as a stop loss is your profit target. This is the price at which you plan to exit the trade if it moves in your favor. Your profit target should be based on your analysis of the stock and market conditions. If you're looking at a stock that's breaking out, you might set your profit target near the next major resistance level. If the stock continues to climb, you take your profit and move on to the next trade. 6. Risk-reward ratio. Now, it's important to think about the risk-reward ratio. This is the relationship between the amount you're risking with your stop loss and the amount you're looking to make with your profit target. A common risk-reward ratio is 1 to 2, meaning you're willing to risk $1 to make $2. This helps ensure that even if some of your trades don't work out, you can still be profitable overall. 7. Stay disciplined. The final step in planning your trade is staying disciplined. Once you've set your entry, stop loss, and profit target, stick to the plan. Don't let emotions take over. If the stock hits your stop loss, don't hesitate to exit. If it reaches your profit target, take your profits and move on. Staying disciplined is what separates successful traders from those who let emotions control their trading. Why planning is key. The key to successful trading isn't just finding a good stock. It's about how you approach each trade. By using scanner data to create a well-thought-out plan, you're giving yourself the best chance to succeed. Planning helps you avoid mistakes and ensures that your trades are based on logic, not emotions. Remember, it's easy to get excited when a stock is moving quickly, but without a plan, you're just gambling. A solid trade plan allows you to manage risk, set clear expectations, and act with confidence. Chapter 5. Tools and Platforms. What broker to use. So, you've made the decision to dive into day trading. And now, one of the most important questions you need to answer is, what broker should you use? Picking the right broker can make or break your trading experience. So let's go over some key factors to help you choose a reliable broker that matches your needs. Why choosing the right broker matters. Before we dive into the criteria, let's talk about why choosing a reliable broker is so important. Your broker is the middleman between you and the market. They're the ones who handle your buying and selling orders, manage your account, and provide you with access to the trading platform. So, you want to make sure that the broker you pick is trustworthy, efficient, and aligned with your trading goals. Criteria for selecting a reliable broker. Now, let's break down the key factors you need to consider when selecting a broker. We'll go through each one step by step so you know exactly what to look for. 1. Commission and fees. First, costs matter. Every time you buy or sell a stock, you're likely to pay a commission or fee to your broker. These fees can eat into your profits, especially if you're trading frequently. So, when choosing a broker, look at their commission structure. Are they charging per trade, or do they have a flat rate fee? Some brokers offer commission-free trades for certain products, which can be really beneficial if you're looking to save money. But be cautious. Sometimes brokers with low fees may make up for it by charging higher spreads or additional hidden fees. So, make sure to factor in all the costs of trading with that broker. 2. Execution speed. In day trading, timing is everything. The faster you can get in and out of a trade, the better. So, you need a broker that can provide fast order execution. Slower execution can lead to slippage, where the price of the stock moves before your order is filled, causing you to get in at a worse price than expected. Make sure the broker you choose has a high-quality platform and can execute your trades quickly, especially in volatile markets. 3. Trading platform and tools. A good broker should offer a user-friendly platform with all the tools you need to execute your trades effectively. This means you should have access to advanced charting tools, real-time data, and risk management features like stop-loss orders. Look for platforms that offer customizable layouts and allow you to set alerts for price levels you're watching. The best platforms also provide paper trading accounts, so you can practice without risking real money before you start trading live. 4. Margin requirements. If you plan to trade on margin, which means borrowing money to trade, you need to check the broker's margin requirements. Margin can significantly increase your buying power, but it also increases risk. Different brokers have different leverage limits, so make sure you understand the margin requirements before you start trading. Know how much margin you'll need to control a position and whether you can handle the risk of margin calls. 5. Customer support. Good customer support can be a lifesaver when things go wrong. Whether it's a technical issue with the platform, a question about your account, or a problem with an order, you want to be able to get help quickly. Make sure the broker you choose has 24/7 customer support and offers multiple ways to get in touch, such as live chat, phone support, or email. You don't want to be stuck in a situation where you can't reach anyone when you need help. 6. Regulations and security. This is absolutely crucial. You want to make sure that your broker is regulated by a reputable authority. Regulations ensure that the broker follows certain standards of operation, which adds a layer of protection to your funds. In the US, look for brokers that are regulated by the SEC, Securities and Exchange Commission, or FINRA, Financial Industry Regulatory Authority. Additionally, make sure your broker has solid security measures in place to protect your personal and financial data. Look for two-factor authentication and encryption protocols to keep your account safe. 7. Available markets and products. Different brokers may offer access to different markets or products. If you're planning to trade more than just stocks, make sure your broker supports other asset classes like options, futures, or even cryptocurrencies if that's something you're interested in. Check if they provide access to the markets you want to trade in. If you're focusing on the US stock market, you'll want a broker that specializes in that. However, if you want to expand into international markets or more complex instruments, you'll need a broker with that kind of access. 8. Educational resources. If you're new to day trading, or even if you're experienced, you'll want a broker that offers educational resources to help you improve your skills. Look for brokers that provide access to webinars, tutorials, and market analysis. This will help you stay on top of market trends and enhance your knowledge. What to avoid when choosing a broker. Now that we've covered what to look for, let's talk about a few red flags that you should watch out for when choosing a broker. Unclear fees. If the broker's fees or commissions aren't transparent, be cautious. Hidden fees can catch you off guard and eat into your profits. Poor reviews. If you see consistent complaints about the broker's platform or customer service, it's best to steer clear. Lack of regulation. Never choose a broker that isn't regulated by a recognized authority. Unregulated brokers can be risky and might not have your best interests in mind. The takeaway. In summary, choosing the right broker is a critical decision that can impact your trading success. When selecting a broker, consider factors like TOC commission fees, execution speed, platform tools, margin requirements, and customer support. Make sure the broker is regulated and provides security for your funds. And always remember, a good broker is one that aligns with your trading style and helps you make the most of your trading opportunities. All right, let's dive into a super interesting topic that a lot of traders consider at some point: trading for proprietary prop trading firms. If you've been thinking about trading professionally, you've probably heard of prop firms. But what exactly does it mean to trade for a prop firm? And what are the opportunities and challenges that come with it? Let's break it down in simple terms. What is a proprietary trading firm? A proprietary trading firm is a company that trades its own capital rather than managing money for clients. So when you trade for a prop firm, you're using their capital to make trades. In exchange, you usually get to keep a portion of the profits you generate. Instead of risking your own money, a prop firm gives you the chance to trade with bigger capital, which can boost your profits, but also brings bigger responsibilities. These firms typically offer training, resources, and even mentorship to help traders succeed. Opportunities in trading for prop firms. So, why would you want to trade for a prop firm? Here are some big opportunities that come with it. 1. Access to larger capital. One of the biggest advantages is that you get to trade with significantly larger amounts of capital than you might have on your own. With more capital, you can take larger positions and potentially make more profit. For example, if you were trading with your own $10,000 account, you might be limited in the trades you can make. But with a prop firm, you could get access to $100,000 or even more, depending on their funding structure. 2. Training and resources. Many prop firms provide traders with training programs, advanced trading platforms, and access to market analysis. This can be a huge boost, especially if you're newer to trading or want to improve your skills. You can learn new strategies, get feedback from experienced traders, and use their technology to help you make more informed decisions. 3. Leverage. Prop firms often offer leverage, which allows you to control larger positions than what your initial capital would allow. This can be incredibly beneficial, as it means you can make more profits from smaller price movements. But be careful. Leverage also means more risk, so you need to be aware of how to manage it effectively. 4. Profit sharing. The best part? If you perform well, you can earn a share of the profits. Depending on the firm, you could earn anywhere from 30% to 90% of the profits you generate. For many traders, this is an attractive way to earn more money than if they were trading with their own capital. Challenges in trading for prop firms. Now let's talk about some of the challenges you'll face when trading for a prop firm. While there are great benefits, it's not all smooth sailing. 1. Strict risk management rules. Prop firms are very serious about risk management. They provide you with their capital, but that also means they have strict rules to ensure you don't blow up the account. You might face daily loss limits, and if you hit those limits, you could be kicked out of the program or face penalties. These rules can feel restrictive at times, but they're in place to protect both you and the firm from major losses. 2. Pressure to perform. Because your profits are tied to how well you trade, there's a certain level of pressure to consistently perform at a high level. Some traders thrive in high-pressure situations, but others can find it stressful to have to meet certain expectations every month. 3. High competition. Depending on the firm, you could be competing with other traders for the same pool of capital. This means you're constantly trying to outperform others to keep your spot and increase your profits. 4. Fees and costs. Some prop firms charge fees for training, data feeds, or platform access. While some firms offer all these resources for free or at a low cost, others might charge for them. Be sure to know what fees you'll be responsible for, as they can add up quickly. 5. No ownership of the capital. While you get to trade with the firm's capital, you don't own it. This can be a downside if you're looking for more independence or want to trade on your terms without someone else setting the rules. You're also limited in how much you can withdraw based on the firm's policies. How to get started with a prop firm. Getting started with a prop firm is relatively straightforward, but it's important to know that each firm has its own requirements. Some firms require you to pass a demo challenge or show a track record of profitability before they offer you capital. Others might require you to go through a training program. Once you pass the evaluation or training, you'll get access to their capital and start trading. Be sure to read the contract carefully and understand their terms and expectations before committing. The takeaway. In summary, trading for a prop firm offers some amazing opportunities, like access to larger capital, training, and the chance to earn a share of the profits. However, there are challenges as well, such as strict risk management rules, high competition, and fees. The key to succeeding in a prop firm is to stay disciplined, manage risk carefully, and perform consistently. If you're thinking about trading for a prop firm, make sure to research your options and choose one that aligns with your trading style and goals. And remember, even though you're trading with someone else's money, the responsibility to trade smartly and manage risk is all on you. All right, traders, let's talk about one of the most important tools you'll ever use in your trading journey, your trading platform. Whether you're a seasoned pro or just getting started, your platform is where you'll spend most of your time. It's where you'll make your buys, sells, and analysis. So it's super important to get the right platform that meets your needs. But with so many options out there, how do you know which one is the best fit for you? Don't worry, I've got you covered. Let's break down the essential features to look for in a trading platform to make sure you've got everything you need to succeed. Goal 1. User-friendly interface. First things first, you want a platform that's easy to use. When you're in the middle of executing a trade, you don't want to be struggling to figure out how to buy or sell. You need everything to be intuitive and streamlined. Look for platforms that have a clean design with easy-to-navigate menus. The less time you spend looking for buttons, the more time you can focus on trading and making smart moves. Customization is also important here. The ability to set up your layout how you want it can make a huge difference in your efficiency. 2. Speed and stability. Speed is key in the world of day trading. The faster you can get your trades in and out of the market, the better. Look for a platform that offers fast order execution so that your trades are filled at the prices you expect without delays. Equally important is stability. Imagine being in the middle of a trade when your platform crashes or lags. That can cost you big. Make sure the platform you choose is reliable and can handle fast-moving markets without any hiccups. You don't want to lose out on an opportunity just because the platform couldn't keep up. 3. Real-time market data. You can't trade effectively if you don't have access to the latest market data. Whether it's stock prices, volume, bid-ask spreads, or charts, your platform needs to deliver real-time information with minimal delays. Without real-time data, you're flying blind. Having access to live market data helps you make quick, informed decisions as market conditions change. The more accurate and up-to-date your data is, the better your chances of making profitable trades. 4. Advanced charting tools. If you want to get serious about trading, you'll need advanced charting tools. Good platforms provide technical analysis tools that allow you to view price action, apply indicators, and identify trends in real time. Look for platforms that offer features like multiple chart types, trend lines, moving averages, and candlestick patterns. These tools will help you spot potential trades, manage risks, and stay on top of the market. Customization is key here too. Being able to adjust the chart's timeframes or indicators to fit your strategy is a huge plus. Shop 5. Risk management features. When it comes to risk management, a solid platform should offer built-in features that help you protect your capital. Look for features like stop-loss orders, take-profit orders, and trailing stops. These allow you to set your exit points automatically and help you limit losses while locking in profits. Good risk management tools take the emotion out of trading, making it easier to stick to your plan and avoid big mistakes. Make sure the platform you use lets you set these parameters easily and without hassle. 6. Order types. A trading platform needs to support a wide range of order types. While market orders and limit orders are common, you may also need stop orders, OCO, one cancels other orders, or trailing stop orders. Having these different options gives you the flexibility to manage your trades in various market conditions. Some traders prefer limit orders to enter at specific prices, while others use market orders for quicker execution. The more options you have, the better. SHA-7. Mobile compatibility. In today's fast-paced market, being able to trade from anywhere is a huge advantage. Look for a platform that has a mobile app that's just as powerful as the desktop version. You never know when a trade opportunity will arise, and being able to access your platform on the go gives you more flexibility. Make sure the mobile version of the platform lets you view charts, place orders, and manage your trades just like you would on a computer. Mobile trading is all about convenience, so don't settle for an app that's too basic or buggy. 8. Customer support. Even if you're using the most user-friendly platform, there may be times when you need help or run into issues. That's where customer support comes in. Make sure the platform you choose offers fast and responsive support through multiple channels, such as live chat, email, or phone support. It's always good to check reviews or ask other traders about their experiences with a platform's support. You don't want to be left stranded when you need assistance. So 9. Security. When it comes to your money and personal information, security should always be a top priority. Look for platforms that offer two-factor authentication, encryption, and other security features to keep your account safe. If a platform doesn't offer robust security measures, it's a major red flag. Your account and funds should always be protected, especially in a field as fast-paced and volatile as trading. 10. Costs and fees. Last but definitely not least, you need to consider the costs associated with using a trading platform. Some platforms offer commission-free trading, while others charge per trade, monthly fees, or platform access fees. It's essential to understand all the fees involved to make sure they don't eat into your profits. The key here is to weigh the costs against the features you're getting. A platform with a higher fee might be worth it if it offers superior tools and faster execution. Just make sure the overall value matches what you're paying. The takeaway. So there you have it. When choosing a trading platform, make sure it has a user-friendly interface, offers fast execution, provides real-time market data, and includes advanced charting tools and risk management features. Also, look for mobile compatibility, great customer support, and top-notch security. Lastly, don't forget to consider the costs and fees to ensure you're getting good value for your money. Choosing the right platform is crucial because it directly impacts your ability to trade efficiently and stay on top of the market. So take the time to research your options and choose the platform that best fits your needs and trading style. All right, let's talk about something that is absolutely crucial for your trading success: real-time market data. If you're serious about day trading, you know how important it is to stay ahead of the curve and make quick decisions. And to do that, you need accurate, timely data. Imagine trying to trade without knowing the latest price movements, volume changes, or market trends. It's like trying to drive a car with a blindfold on. So let's break down why real-time data is a game changer for traders. What is real-time market data? At its core, real-time market data refers to the live stream of information about the financial markets. This includes stock prices, bid-ask spreads, market depth, volume of trades, and much more. Essentially, it's the heartbeat of the market. Without access to live data, you're trading with outdated information, and in a fast-moving market, that can be a huge disadvantage. Why is real-time market data so important? 1. Making quick decisions. When you're day trading, every second counts. The price of a stock can change in the blink of an eye, and you need to make decisions in real time. If you're not getting instant updates, you could miss out on profitable trades, or worse, enter a trade at the wrong price. For example, let's say you're looking at a stock that's moving fast, and you decide it's time to enter. If the data you're looking at is delayed by even a few seconds, you might be buying at a higher price than you wanted, or selling too late, which could mean lost profits. Number 2, spotting opportunities. Real-time market data is essential for spotting opportunities as they happen. When prices are moving quickly, new trends, patterns, or breakouts can appear in minutes, sometimes seconds. If you're waiting on delayed data, you're just not going to be able to react quickly enough. For instance, if a stock is moving in a particular direction, you want to catch that momentum immediately. The only way to do that is by having real-time updates. 3. Accuracy. The accuracy of your market data is just as important as the timing. If the data you're seeing is incorrect or outdated, it's going to lead you to make bad trades. Accurate data helps you understand the true market conditions, ensuring that the decisions you make are based on what's really happening, not what was happening a few minutes ago. For example, a stock might look like it's in an uptrend, but if your data is lagging, you could miss a quick price reversal. Real-time, accurate data lets you stay ahead and avoid costly mistakes. 4. Staying ahead of market movements. When you're trading, it's not just about reacting to price movements. It's about staying ahead of them. If you're watching a stock closely and you notice unusual volume spikes or price changes, that could signal a potential breakout or breakdown. The key is to act before the rest of the market does. If you're using real-time data, you can spot these shifts in market sentiment before they become obvious to everyone else, giving you the upper hand. Number 5, making informed decisions. Real-time market data isn't just about speed, it's about making informed decisions. By analyzing live charts, price action, and market depth, you can get a clearer picture of what's happening in the market. This enables you to identify patterns, trends, and support or resistance levels that can guide your trades. For example, if a stock is bouncing off a support level and you see real-time price action confirming this, you can enter the trade with more confidence. Without accurate real-time data, it's like trying to make decisions without all the facts. 6. Keeping track of your positions. When you're actively trading, you're likely holding multiple positions at once, and you need to be able to monitor them in real time. Whether it's setting stop-loss orders, tracking profits, or adjusting your exit strategy, accurate and timely market data is vital for managing risk and ensuring your trades are in line with your plan. If the data you're using is delayed, it could throw off your exit points, and that's where you get caught in bad trades. Real-time data helps you adjust your positions on the fly and ensures you stay on top of the market. The bottom line, why real-time market data is non-negotiable. To wrap it up, here's the bottom line. Real-time market data is not just a nice-to-have tool. It's essential for anyone who wants to trade successfully. It gives you the speed, accuracy, and insight you need to make smart decisions and stay ahead of market movements. When you're day trading, the difference between success and failure often comes down to timing. Having access to live data helps you capitalize on opportunities before they pass you by and ensures you're always trading with the most up-to-date information. So don't settle for delayed or inaccurate data. Choose a platform that provides real-time market updates and stay on top of the game. Hey there, traders. In this section, we're going to dive into one of the most powerful tools you can use to understand the true market depth, NASDAQ Level 2 and the bid-ask spread. These are key concepts for anyone looking to make better, more informed trades, and trust me, once you understand them, you'll be able to see the market in a whole new way. What is NASDAQ Level 2? Let's start with NASDAQ Level 2. In simple terms, Level 2 is a real-time detailed view of the market. It shows you more than just the current price. It shows you the order book, a list of all the orders that traders are placing at different price levels. This is like looking under the hood of the market and getting the real picture of what's going on. Understanding the order book. At its core, an order book shows you the buy orders, bids, and sell orders, asks, that are currently in play. These orders are stacked in a ladder format, showing you how much of a particular stock is available at each price point. The bid is the price at which buyers are willing to purchase a stock. The ask is the price at which sellers are offering to sell the stock. The gap between the bid and ask prices is called the spread, and it gives you a lot of insight into the market sentiment. A tight spread means there's not much difference between buying and selling prices, which typically means the stock is liquid and the market is active. A wide spread could signal that the stock is either volatile or has low liquidity, which could make it more difficult to execute your trades at the prices you want. The bid-ask spread. Now let's break down the bid-ask spread in more detail. The spread is simply the difference between the highest bid and the lowest ask price. It's a key indicator of supply and demand in the market. A narrow spread means that supply and demand are closely matched, so there's plenty of activity in the market. A wide spread could indicate that there's less activity, or it might mean that sellers are holding out for higher prices, or that buyers are reluctant to pay more. Understanding the spread is crucial because it affects your trading cost. When you buy at the ask price and sell at the bid price, the difference is your cost of trading. The smaller the spread, the less you'll pay in trading fees, making it easier to profit from your trades, reading the market depth. So what does this all mean for your trading strategy? When you look at NASDAQ Level 2, you're essentially seeing the depth of the market. This depth is represented by how much volume exists at various price levels. Let's say you're eyeing a stock and you see a lot of buy orders stacking up at a certain price level. That tells you there's strong demand for that stock at that price. On the flip side, if you see a lot of sell orders at a particular price, it could signal that there's resistance at that price. Essentially, you're looking for imbalance between the bids and asks. If the buy side is stronger, it could signal that the stock is likely to go up. If the sell side is heavier, there could be a pullback or drop. Key insights from Level 2. Here are some key insights you can gather by watching the order book in real time. 1. Momentum. If you notice heavy buying interest and a small ask price, it suggests the stock might be ready to move upward. Likewise, if there are large sell orders with little demand on the buy side, the stock might be headed downward. 2. Liquidity. Watching the size of the orders can give you an idea of the liquidity of the stock. If you see large orders at the bid and ask, that means there's high liquidity, and you can expect to enter or exit trades easily. 3. Resistance and support. Level 2 helps identify where there might be resistance and support. If there's a large stack of buy orders at a certain price, that could act as support, meaning the stock is less likely to fall below that price. Conversely, a large stack of sell orders at a certain price creates resistance, suggesting the stock might have trouble rising past that price. Number 4, market sentiment. The way the order book stacks up tells you a lot about the market sentiment. If there's a lot of buying activity, it suggests a bullish market. If selling orders are dominating, it signals a bearish market. Watching this flow in real time gives you a better idea of where the market is headed and allows you to make more informed decisions. Putting it all together. To wrap it up, NASDAQ Level 2 and understanding the bid-ask spread are critical for reading the true strength of the market. By keeping an eye on these metrics, you can gauge where the stock is likely to go and adjust your strategies accordingly. The more you watch the order book and understand the market depth, the better equipped you'll be to make smart, informed trades. So, whether you're looking to spot breakouts, pullbacks, or just understand market sentiment, Level 2 is your go-to tool for deeper insights. Indicators on my charts. All right, traders. If you're starting to get serious about day trading, then indicators are something you're definitely going to want to get familiar with. Technical indicators are like your trading GPS. They help you navigate the markets, give you key insights, and show you where and when to make your moves. Now, there are tons of indicators out there, but today we're going to talk about the most common ones used by day traders to make smart decisions. What are indicators? In the simplest terms, indicators are mathematical calculations based on the price and volume of a stock. They appear as lines, histograms, or charts on your trading platform, and they provide insights into things like trend direction, market strength, and potential entry and exit points. Think of them as your market signals, guiding you to the right opportunities. Let's dive into the most popular indicators. 1. Moving averages, MA. One of the most basic and widely used indicators is the moving average. There are different types, but the simple moving average, SMA, and exponential moving average, EMA, are the ones you'll likely use most in day trading. SMA. This takes the average price of a stock over a specific time period. For example, a 50-day SMA takes the average of the last 50 days of closing prices. EMA. This is similar, but gives more weight to the most recent prices, making it more responsive to price changes. Why use moving averages? They help you identify the overall trend. If the price is above the moving average, the trend is upward. If it's below, the trend is downward. Crossovers, when a short-term MA crosses above or below a long-term MA, can also signal potential buy or sell opportunities. 2. Relative Strength Index, RSI. The RSI is an oscillator that tells you whether a stock is overbought or oversold. It ranges from 0 to 100 and is usually plotted below your price chart. If the RSI is above 70, it suggests the stock is overbought, meaning it might be due for a pullback. If it's below 30, the stock is oversold, which could signal that it's underpriced and might be set to bounce back. Why use RSI? This indicator helps you identify potential reversals. When the stock moves into extreme territory, it can indicate that the price is either about to correct or reverse. 3. Bollinger Bands are like envelopes that are drawn above and below a moving average, typically the 20-period SMA. These bands expand and contract based on volatility. When the stock is moving close to the upper band, it could mean that the stock is overbought. When it's near the lower band, it could mean the stock is oversold. Why use Bollinger Bands? They give you a sense of a stock's volatility and can help you spot breakouts or breakdowns. If the price breaks out of the bands, it might signal a strong trend continuation. 4. MACD, Moving Average Convergence Divergence. The MACD is a trend-following momentum indicator that shows you the relationship between two moving averages of a stock's price. It has 3 main components: the MACD line, the difference between the 12-day EMA and the 26-day EMA, the signal line, a 9-day EMA of the MACD line. The histogram shows the difference between the MACD line and the signal line. Why use MACD? The MACD helps you spot trend reversals and momentum shifts. When the MACD line crosses above the signal line, it's a bullish signal. When it crosses below, it's a bearish signal. 5. Volume. Volume is one of the most straightforward indicators, but it's crucial for understanding market strength. It simply shows how many shares of a stock are being traded. If there's high volume with a price movement, it means there's strong market participation, which can validate a move. If there's low volume, it can signal weak price movement, suggesting the move may not be sustainable. Why use volume? Volume confirms the strength of a trend. A price move accompanied by high volume is much more likely to continue than one with low volume. 6. Stochastic oscillator. The stochastic oscillator is another momentum indicator that compares a stock's closing price to its price range over a specific period of time. When the stochastic is above 80, the stock is considered overbought. When it's below 20, the stock is oversold. Why use stochastic oscillator? This tool helps you find overbought or oversold conditions, giving you potential entry points when the market is reversing. How to use indicators effectively. Now, here's the deal. No indicator is perfect on its own. In fact, over-relying on one indicator can be risky. It's best to use a combination of indicators to confirm your trades. For example, you might use the RSI to spot potential overbought conditions and then look for a MACD crossover to confirm a trend reversal. Also, remember that indicators are lagging. They follow price movements, so you always need to combine them with your price action and market analysis. The bottom line: use indicators wisely. To sum it up, indicators are your toolkit for reading the markets. They give you insights into price trends, market strength, and potential entry and exit points. But remember, they're just tools. It's up to you to interpret them and make smart decisions. Combine them with your own strategy, and you'll be better equipped to make informed trades. Buy and sell orders. All right, traders, let's talk about orders. In the world of day trading, you need to know the different types of buy and sell orders so you can enter and exit the market at the right time and right price. Whether you're a beginner or an experienced trader, knowing how to place orders effectively is a crucial skill. So, let's break down the basic order types you'll use and how they work. What are buy and sell orders? In simple terms, a buy order is an order you place when you want to purchase a stock, and a sell order is what you place when you want to sell a stock you own. These orders are what actually allow you to execute your trades. But here's the thing. There are different types of orders that give you different levels of control over your trades. Let's dive into the main ones you'll be using. Market orders. A market order is the simplest and fastest type of order. When you place a market order, you're telling your broker to buy or sell the stock immediately at the best available price. When to use. Market orders are perfect when you want to get into or out of a position quickly and don't mind paying a small price difference. Pro tip: market orders are ideal for highly liquid stocks where there's little to no spread between the bid and ask price. But keep in mind, market orders are vulnerable to slippage. This means that the price you see on your screen might not be the exact price you get, especially in fast-moving markets. Limit orders. Now, a limit order is different. With a limit order, you're saying, I'm only willing to buy or sell at this specific price or better. Buy limit order. You place an order to buy at a price below the current market price. Sell limit order. You place an order to sell at a price above the current market price. When to use. Limit orders are great if you're looking for a specific price and don't want to pay more or sell for less than that price. For example, if a stock is trading at $100 and you want to buy it for $98, you'd place a buy limit order at $98. The order will only be filled if the stock reaches $98 or lower. Pro tip: limit orders help you avoid slippage because you're in control of the price. However, the downside is that your order might not be filled if the stock doesn't reach your specified price. Stop orders, stop loss orders. A stop order, also known as a stop loss order, is a bit different. It's used to protect your position by automatically triggering a market order once the price hits a certain level. When to use. If you buy a stock at $100 and you want to limit your loss if it drops below $95, you would place a sell stop order at $95. If the price hits $95, the stop order becomes a market order and sells the stock at the next available price. Why it's important. This type of order is great for risk management. It helps you limit potential losses by automatically selling a stock if its price drops to a certain level. Stop limit orders. A stop limit order combines elements of both the stop order and the limit order. With this order, you set a stop price at which the order is triggered, but once it's triggered, a limit order is placed at a price you specify. How it works. Let's say you have a stock at $100 and want to sell it if it drops to $95, but you only want to sell it for at least $94. You would place a stop limit order with a stop price of $95 and a limit price of $94. This means your stock will be sold if the price drops to $95, but only if it can be sold for $94 or higher. When to use. Stop limit orders are useful when you want to set a risk tolerance for both the stop price and the limit price. However, The risk is that if the stock price moves too quickly through your limit price, your order might not be filled. Trailing stop orders. A trailing stop order is like an automatic stop loss that moves with the market. If you're in a profitable trade and the stock price is going up, the stop price will adjust upwards too. How it works. Let's say you buy a stock at $100 and you set a trailing stop of $5. If the stock moves up to $110, your trailing stop will automatically adjust to $105. If the stock then starts falling, the trailing stop will stay at $105. And if it hits that price, your stock will be sold. When to use. Trailing stop orders are great for locking in profits while still giving the stock room to move. They let you ride the trend while protecting yourself from large losses. Good till canceled GTC orders. A good till canceled GTC order stays open until it is either filled or you cancel it. It's the opposite of a day order, which automatically expires at the end of the trading day if it hasn't been filled. When to use. GTC orders are useful if you want to place an order and leave it open for an extended period, like for multiple days or weeks. You don't have to keep entering the order each day. The bottom line, which order to use. Choosing the right type of order depends on your trading goals and strategy. If you need to get in or out of a trade quickly, go with a market order. If you want to buy or sell at a specific price, use a limit order. If you want to protect your profits or cut your losses automatically, consider a stop order or trailing stop. If you want an order to stay open for multiple days, a GTC order is the way to go. Mastering these orders is key to becoming a confident and effective trader. Knowing when and how to use each one will give you the flexibility to adapt to any market condition, keep your risk in check, and maximize your profits. Hotkeys. All right, traders, let's dive into one of the game changers for your trading speed, hotkeys. These little shortcuts can drastically speed up your trade execution and help you make quick decisions in fast-moving markets. What are hotkeys? Hotkeys are like the shortcut keys on your keyboard. Think Control-C to copy or Control-V to paste, but for trading. They allow you to execute orders, switch charts, and do other trading actions instantly without having to click through multiple screens or menus. Now, if you're a day trader, you know that speed is everything. The quicker you can enter and exit trades, the better your chances of capitalizing on those short-term market moves. Hotkeys give you that edge, allowing you to make split-second decisions without having to fumble around in the trading platform. Why hotkeys are crucial. When you're day trading, you're dealing with fast-paced markets where a few seconds can make all the difference. Whether you're placing a market order, setting a stop loss, or canceling a trade, the time it takes to click through menus can cost you money. That's where hotkeys come in. With hotkeys, you can execute critical actions like entering, modifying, or exiting trades without hesitation. Setting up hotkeys. Most trading platforms allow you to customize hotkeys. You can assign specific keys on your keyboard to different actions. For example, you can set F1 to buy a stock at market price, F2 to sell, F3 to place a stop-loss order. This customization allows you to choose the hotkeys that make the most sense for your trading style. Key benefits of hotkeys. 1. Speed. Hotkeys make your trades faster. Instead of wasting time navigating through menus or using your mouse, you can press a key and have your order in the market instantly. 2. Efficiency. Hotkeys let you focus on the market, not on clicking buttons or getting distracted. With practice, your reaction time will improve and you'll make quicker decisions. 3. Accuracy. The quicker you are at entering and exiting trades, the more accurately you can manage your positions. Hotkeys help you avoid mistakes that can happen when you're rushing or getting distracted by the trading interface. 4. Consistency. Hotkeys help make your trading more consistent. By using the same keys for the same actions, you reduce the risk of human error. Every trade feels more controlled because you're using a set routine. How to use hotkeys effectively. While hotkeys can definitely improve your trading, practice makes perfect. Here are some tips to make sure you're using hotkeys effectively. Start slow. Begin with a few simple hotkeys like buy, sell, and cancel. As you get comfortable, you can add more complex functions like placing stop-loss orders, scaling in and out of positions, or adjusting your risk management parameters. Test them. Practice executing trades with hotkeys using a demo account or paper trading account. This way, you can get comfortable with your setup without risking real money. Don't overcomplicate. It's tempting to create dozens of hotkeys, but that can lead to confusion. Start with the essential ones that will help you execute the most important actions quickly, then build from there. Stay organized. Once you have your hotkeys set up, make sure you know what each key does. If you assign a key to execute a market order and another for a stop order, be absolutely clear about which key does what. Hotkey setup examples. Here's an example of a basic hotkey setup you can try. Control B for buying a stock. Control S for selling a stock. Control L for setting a limit order. Control M for placing a market order. Control X for canceling a pending order. Conclusion. Hotkeys are a powerful tool in your trading arsenal. They allow you to make quicker decisions, execute trades faster, and become a more efficient trader. The beauty of hotkeys is that they save you time, reduce mistakes, and help you stay focused on the market, making them an absolute must for any serious day trader. Watchlist and scanners. Hey traders, let's talk about something that can really make a difference in your day trading success. Your watch list. A well-curated watch list combined with powerful scanners can help you spot opportunities in the market before they happen. What is a watch list? A watch list is basically a list of stocks you're keeping an eye on. These are the stocks that have high potential to make big moves, and you want to be ready to trade them when the time is right. Think of it as your market radar, the stocks you think have the best chance of being profitable, and you want to keep them close. Why you need a watch list. In day trading, timing is everything. You don't want to waste time scrolling through thousands of stocks, trying to figure out which one to trade. A good watch list keeps everything organized and helps you stay focused on the stocks that matter. By having a watch list, you're able to monitor stocks with the highest volatility, volume, and potential for movement. This gives you a huge edge in spotting trading opportunities early. How to build a watch list. Building your watch list isn't about just adding random stocks you've heard of. It's about being strategic. Here are a few tips to help you create an effective watch list. 1. Look for volatility. Stocks that are volatile, meaning they move a lot during the day, are great for day trading. You want stocks that have the potential to make big price swings, which can create profits. Check stocks with big pre-market moves, or those that are gapping up or down from the previous day's close. 2. Focus on volume. A stock that has low volume is harder to trade because there are fewer buyers and sellers. Focus on stocks with high trading volume. This ensures you can enter and exit positions quickly without a lot of slippage. Look for stocks that are being actively traded throughout the day. 3. Sector trends. Keep an eye on sector-specific trends. Sometimes certain sectors, like tech, healthcare, or energy, can be moving together due to news or events. Knowing which sectors are hot can help you find stocks that are likely to move. 4. News and events. News can drive huge market moves. Stocks that are tied to breaking news or major events, like earnings reports, FDA approvals, etc., can experience big price action. So, make sure you're always updated on the latest market-moving news and include those stocks on your watch list. 5. Set criteria. Don't just add stocks randomly. Set clear criteria for what qualifies a stock for your watch list. It could be price range, volatility, volume, or other technical indicators that align with your trading strategy. How to maintain your watch list. Having a watch list is only half the battle. Maintaining it is just as important. Here's how you can make sure your watch list stays relevant. 1. Review regularly. Make it a habit to review your watch list at the start of each day. Stock conditions change quickly, so you need to make sure the stocks you're watching are still aligned with your goals for that day. 2. Remove underperformers. If a stock hasn't moved the way you expected or doesn't meet your criteria anymore, remove it from the watch list. Don't waste time on stocks that aren't performing. 3. Add new stocks. The market is constantly changing, so be on the lookout for new stocks that might be worth watching. If a stock starts showing signs of big movement, add it to your list. 4. Track patterns. As you gain more experience, you'll start to notice certain patterns, stocks that perform well at certain times of the day, stocks that follow news stories, etc. Adjust your watch list to reflect these insights, and you'll improve your ability to spot profitable trades. Scanners, the secret weapon for watch lists. Now that we've covered the basics of building a watch list, let's talk about scanners. Scanners are tools that automatically scan the market for stocks that meet your specific criteria. These can help you find the best stocks for your watch list without having to manually search for them. Here's how scanners work. Real-time alerts. Scanners can give you real-time alerts when stocks meet certain conditions. For example, you can set up a scanner to alert you when a stock is gapping up by a certain percentage or when its volume spikes above a certain level. Customizable filters. Most scanners let you filter stocks based on various criteria like price, volume, volatility, and more. You can fine-tune the filters to match your trading style, which makes the scanner a powerful tool for finding stocks with high potential. Speed. Scanners work fast. Instead of manually searching through a bunch of stocks, scanners will automatically look through thousands of stocks for you in just a few seconds, giving you more time to focus on trading. Tips for using scanners effectively. Use multiple scanners. To cover more ground, consider using multiple scanners with different criteria. One scanner can look for stocks with high volume, while another can search for stocks that are breaking out above key levels. Combining scanners gives you a wider range of potential trades. Don't overload. When you first start, you might be tempted to set up scanners for every possible condition, but that can overwhelm you. Start simple with a few key filters and build your scanner strategy over time. Use scanners as a tool, not a crutch. Scanners are powerful, but don't rely on them entirely. You should still be doing your own research and using your technical analysis skills to make final trading decisions. The bottom line, building and maintaining a solid watch list paired with scanners can be a game changer for your day trading. The key is to stay organized, regularly review your list, and keep adding stocks that meet your specific trading criteria. Scanners take it up a notch by automating the process, saving you time and helping you spot potential trades instantly. Community of traders. Hey traders, today we're diving into something that can seriously boost your trading journey. Being part of a trading community. Whether you're just starting out or you're a seasoned pro, connecting with other traders can have a huge impact on your trading success. Why join a trading community? You might be wondering, why do I need a trading community? Isn't trading something I do alone? Well, while trading can be done solo, learning and growing as a trader is a whole different story. And that's where trading communities come in. What exactly is a trading community? A trading community is basically a group of traders, whether online or in person, who come together to share insights, strategies, and experiences. It's a place where you can discuss trades, ask questions, and learn from others' successes and mistakes. These communities can range from online forums, Discord groups, Facebook groups, or even in-person meetups. The key benefits of being in a trading community. Now, let's break down why participating in a trading community can help take your trading to the next level. 1. Learning from others. One of the biggest advantages of being part of a trading community is the learning. Trading is all about constantly improving and adapting, and you don't have to do it alone. In a community, you'll get the chance to see how other traders approach the market, and you can pick up new strategies and techniques. It's like having a trading mentor from all over the world. You can ask questions, get feedback on your trades, and discuss different approaches that you might not have considered. Sometimes the best trading ideas come from other people who see the market in a completely different way than you do. 2. Stay motivated and accountable. Trading can be lonely. When things aren't going well, it's easy to feel like you're in it alone. But in a community, you have people to share the ups and downs with. When you're stuck or feeling discouraged, a supportive group of traders can lift you up and remind you why you started trading in the first place. Plus, being part of a community can keep you accountable. When you share your trading goals and strategies with others, you're more likely to stick to your plan and avoid emotional trading. You don't want to be the one who falls off track while everyone else is making progress. 3. Real-time information and updates. The market moves fast, and having a community gives you access to real-time updates. You can hear about news, market shifts, or hot stocks before they even hit the mainstream. This information is golden when you're day trading and need to make quick decisions. Many communities have traders who actively share their thoughts, insights, and alerts throughout the day. This can give you an edge because you're getting timely information from people who are also actively trading. 4. Networking opportunities. Being part of a trading community also gives you the chance to network with other traders. Whether you're looking for a trading partner, seeking mentorship, or just want to make friends in the trading world, a community is the place to connect with like-minded people. You never know when a conversation in the community might lead to a valuable collaboration or opportunity. It could even be the start of a profitable partnership that boosts both of your trading careers. 5. Gaining perspective. It's easy to get caught up in your own head when you're trading, especially when things aren't going well. Being in a community allows you to get perspectives from others who might be in a different emotional state or have a completely different view of the market. Sometimes, just hearing someone else's analysis or advice can help you see the market from a fresh point of view. 6. Avoiding pitfalls. Trading can be a dangerous game if you don't know what you're doing, but by being part of a community, you can avoid common mistakes. Communities are full of traders who have already gone through the learning curve and can warn you about common pitfalls. They can point out potential mistakes you might be making, share resources, and even help you recover from a loss. 7. Expanding your knowledge base. You can't learn everything from books or courses alone. A trading community lets you dive deeper into topics you might not understand fully, whether it's technical analysis, specific trading strategies, or how to manage risk. Plus, different traders bring their own unique experiences. This is where you can find out about strategies you wouldn't have considered on your own. How to get the most out of a trading community. Just joining a trading community isn't enough. You have to actively participate to get the most out of it. Here's how to maximize your benefits. 1. Ask questions. Don't be afraid to ask questions or share what you're struggling with. Chances are someone has been through the same thing. 2. Share your experiences. Don't just be a passive listener. Share your own wins and losses. You'll get valuable feedback, and it'll help others learn from your journey too. 3. Stay active. Participate in discussions, watch webinars, attend meetups, stay engaged. The more active you are, the more you'll learn. 4. Respect others. Trading communities work best when everyone is respectful and supportive. Don't just join for the info, contribute to the community as well. Conclusion. Being part of a trading community isn't just about having someone to talk to. It's about learning, staying motivated, networking, and sharing experiences. A strong community can help you navigate the ups and downs of trading and give you the tools to improve your skills. So, if you're not already part of one, now is the perfect time to start connecting with other traders. Chapter 6, Introduction to Candlesticks. Hey traders, today we're going to talk about one of the most important tools for any day trader, candlesticks. If you're new to trading, this chapter is a must-know because understanding candlesticks is like learning the language of the market. So, let's dive into what candlesticks are, how they work, and how you can use them to make smarter trading decisions. What are candlesticks? A candlestick is a charting tool used in technical analysis that represents price movement over a specific time period. You might have already seen them in your trading platform, but do you know what each part of the candlestick means? Each candlestick is made up of a body and wicks, also known as shadows. The body represents the open and close price, and the wicks show the high and low prices during that time period. Bullish candlestick. A green or white candlestick means that the price closed higher than it opened. This suggests upward momentum in the market. Bearish candlestick. A red or black candlestick means that the price closed lower than it opened. This indicates downward pressure on the price. Understanding candlestick anatomy. Let's break down the components of a candlestick. The body. This is the thick part of the candlestick. It shows the range between the open and close prices. If the close is higher than the open, you get a bullish body, green or white. If the close is lower than the open, it's a bearish body, red or black. The wicks, shadows. These are the thin lines above and below the body. The upper wick shows the highest price reached during the time period, while the lower wick shows the lowest price. Why candlesticks matter for day traders. Candlesticks are popular because they give you more information at a glance than other types of charts, like line charts. They not only show the price movement, but also how that price moved within a given time frame. For example, if you see a long green candlestick, that tells you the price moved up significantly with strong buying momentum. On the flip side, a long red candlestick shows strong selling pressure and a significant price drop. Candlestick patterns, what they reveal. Candlesticks don't just work alone. They often form patterns that tell you more about market sentiment. Some common patterns to look out for are doji. A doji is a candlestick where the open and close are very close to each other, forming a tiny body. It indicates indecision in the market, which could signal a potential reversal. Hammer. A hammer candlestick has a small body with a long lower wick. It usually forms at the bottom of a downtrend and signals that the price might start going up. It's a bullish reversal signal. Engulfing patterns. When one candlestick fully engulfs the previous one, it can signal a strong trend reversal. A bullish engulfing pattern happens when a small red candlestick is followed by a larger green one, suggesting the start of an uptrend. How to read candlestick charts. Reading candlestick charts is about recognizing the story that the market is telling you. A single candlestick can tell you a lot about market sentiment, but when you look at a sequence of candlesticks, you can spot trends, reversals, and market momentum. Bullish trends. Look for a series of green candlesticks, or a combination of patterns like higher highs and higher lows. Bearish trends. Look for a series of red candlesticks or patterns like lower highs and lower lows. Reversals. Be on the lookout for candlestick patterns that signal a reversal, like the hammer or engulfing patterns we discussed. Using candlesticks for your trades. Now, how do you actually use candlesticks in your trades? Here's a quick rundown. 1. Identify market sentiment. Is the market trending up or down? Look at the series of candlesticks to understand the overall direction. 2. Look for key patterns. Spot reversal or continuation patterns. A hammer could signal the end of a downtrend, and an engulfing pattern could indicate the start of a new uptrend. 3. Combine with other indicators. Candlesticks work great in combination with other indicators like moving averages or RSI. When you spot a candlestick pattern along with other signals, you get even more confirmation for your trade. The power of candlestick charts. Candlestick charts give you the ability to see the emotions of the market at a glance. They show you whether buyers or sellers are in control and whether the market is in a state of indecision or heading in one clear direction. By understanding how to read candlestick patterns and interpreting their meanings, you'll be able to predict market moves with more confidence. Over time, you'll notice how certain patterns tend to repeat in the market and give you a predictable edge. Understanding market sentiment through candlesticks. Hey traders, in this section, we're going to dive into a key concept that can make or break your trading strategy. Understanding market sentiment. And the best part, we'll do it using candlesticks. Yes, those little price bars on your charts aren't just random. They reflect the psychology of the market, the emotions and decisions of all the traders involved. Let's break this down and see how you can use candlestick patterns to understand market sentiment and make better trading decisions. What is price action? First off, let's define price action. It's simply the movement of price over time. Price action is a reflection of everything happening in the market: buyers, sellers, and all their emotional reactions. By reading price action, we get to see how the market is feeling, whether it's bullish, upward, bearish, downward, or just plain indecisive. How candlesticks show market sentiment. Candlestick charts give you a visual snapshot of market sentiment. Each candlestick represents a specific time period, and by looking at these candles, you can instantly tell the mood of the market at that moment. Bullish sentiment. If the price is going up, we'll see bullish candlesticks, usually green or white. These candlesticks show that buyers are in control and pushing prices higher. The longer the candlestick, the stronger the buying sentiment. Bearish sentiment. On the flip side, if the price is going down, we'll see bearish candlesticks, often red or black. These show that sellers are dominating and pushing the market lower. A long red candlestick means strong selling pressure. Indecision. When the market is unsure, it shows up as candlesticks with small bodies and long wicks, like a doji. This shows there's no clear direction. Both buyers and sellers are in a battle, and the market is uncertain. How market sentiment drives price action. Market sentiment is what drives price action. When a group of traders feels confident and optimistic, the market tends to rise as more traders buy. But when there's fear, uncertainty, or doubt, prices fall as traders sell to avoid losses. Candlesticks give us a clear picture of these emotions. When we see a long green candlestick, it's like the market is saying, buyers are excited and pushing prices up. But when we see a long red candle, it's telling us sellers are in control and the price is dropping fast. Candlestick patterns and market psychology. Certain candlestick patterns are like signals that show how the market is feeling and where it might be headed next. Let's talk about a few key patterns. Bullish engulfing pattern. This happens when a small red candlestick is followed by a big green candlestick. It signals that buyers have taken control after a period of selling, and the market could move upward. It's like the emotion of optimism coming back into the market. Bearish engulfing pattern. This is the opposite of the bullish engulfing, where a large red candlestick follows a small green one. This shows that sellers have overwhelmed the buyers, and the market might be heading lower. Think of it as fear taking over. Hammer. A hammer candlestick is a bullish reversal pattern that forms after a downtrend. The market tried to sell off, but buyers stepped in and drove the price back up. It's like a message of hope, showing that the buyers aren't giving up just yet. Doji. A doji is a candlestick where the open and close prices are very close, meaning there was a lot of indecision. It shows that neither buyers nor sellers could gain control. A doji can signal a turning point where the market might be about to decide its next move. Mass psychology and its role in price action. The psychology of the crowd plays a huge role in price action. Every trader has their own emotions and thoughts, but when you combine all those emotions, you get a mass psychology that drives the market. Fear and greed. These are the two most powerful emotions in the market. When there's fear, prices drop as people sell, trying to protect their money. When there's greed, prices rise as people buy, hoping to profit. Herd mentality. Traders often follow the crowd. If everyone is buying, others tend to buy too, fearing they'll miss out on profits. Similarly, when everyone is selling, others join in to avoid losses. Candlestick patterns reflect this herd behavior. Group emotions are shown in the price action. Using candlestick patterns to read market sentiment. To become a successful trader, you need to read the room. That is, understand what the market is feeling at any given moment. Candlestick patterns are one of the best ways to do this. By learning to spot key patterns and understanding their psychological significance, you can get a glimpse into the collective mindset of the market. Combining candlesticks with other tools. While candlesticks give you great insights into market sentiment, it's important to combine them with other tools to get a full picture. For example, combining candlestick patterns with support and resistance levels or indicators like the Relative Strength Index, RSI, can give you extra confirmation for your trades. Bullish candlesticks. patterns indicating potential upward movement. Hey traders, now let's talk about bullish candlesticks. These are the patterns that show us when the market is getting ready to go up. If you're looking to spot potential buying opportunities, then understanding bullish patterns is a must. In this section, I'm going to walk you through some of the most important bullish candlestick patterns that indicate the market might be heading higher. So, let's dive in. What are bullish candlesticks? In simple terms, bullish candlesticks are candles that signal upward price movement. When you see a bullish candlestick pattern forming, it's a sign that the buyers are in control and prices are likely to rise. The color of the candle is usually green or white, showing that the closing price is higher than the opening price, meaning that buying pressure has pushed the price up. But what makes these candles even more valuable is their context. It's not just about the candle itself, but what's happening before and after that candle appears. So let's look at some key bullish patterns you'll want to keep an eye on. 1. Bullish engulfing pattern. One of the strongest bullish patterns is the bullish engulfing pattern. This happens when a small red candle is followed by a big green candle. Here's what this pattern tells us. The first candle, the red one, shows that sellers were in control. But then the second candle, the green one, engulfs the red one completely, meaning buyers have taken over and prices are likely to move higher. This pattern indicates that there's a shift in market sentiment. What was once a downtrend could now turn into an uptrend. If you see this pattern at the bottom of a downtrend, it could signal the start of an upward move. 2. Hammer pattern. Next up, let's talk about the hammer pattern. A hammer looks like, well, a hammer. It has a small body at the top with a long wick pointing down. This pattern shows up after a downtrend and signals that the price tried to fall, but the buyers stepped in and pushed the price back up. The hammer shows that even though sellers tried to drive the price down, the buyers were strong enough to stop the fall and drive the price back up. This is a bullish reversal pattern, meaning it often indicates that the market might be about to turn around and start moving upwards. 3. Morning star pattern. The morning star pattern is another classic bullish pattern. It's a 3-candle formation that works like this. The first candle is a big red candle, showing that sellers were in control. The second candle is a small candle, which means the market is indecisive. This could be a doji or a small red-green candle. The third candle is a big green candle, showing that buyers have stepped in and the market is reversing to the upside. The Morningstar pattern indicates a strong bullish reversal, especially when it appears at the bottom of a downtrend. It's like a signal that the sellers have exhausted themselves, and now the buyers are ready to take control. 4. Piercing line pattern. The piercing line is a 2-candle pattern that signals a possible reversal from a downtrend to an uptrend. It looks like this. The first candle is a long red candle. The second candle is a green candle, and it opens below the low of the first candle, but closes above the midpoint of the first red candle. The piercing line shows that even though the market was going down, the buyers are coming in strong and are now pushing the price back up. This pattern suggests that the selling pressure is fading and the buying pressure is starting to increase. 5. 3 white soldiers pattern. This is a powerful pattern that consists of 3 consecutive green candles. These candles should be long, with each one closing higher than the previous one. The 3 white soldiers pattern suggests that the market is bullish and the buying momentum is increasing. This pattern usually appears after a downtrend and indicates that buyers are in control and the market could continue moving upward. It's one of the strongest bullish patterns you'll come across. How to trade with bullish candlesticks. So now that you know what these patterns look like, how do you trade with them? Here are some tips. Look for confirmation. Never trade a bullish pattern just because you see it. Always wait for confirmation, like the price continuing to move up after the pattern forms. Combine with other indicators. Use other indicators like RSI, Relative Strength Index, or moving averages to confirm that the trend is indeed turning bullish. Use proper risk management. No pattern is perfect, so make sure you manage your risk. Always have a stop loss in place and ensure your position size matches your risk tolerance. Why bullish candlestick patterns matter. Understanding bullish candlestick patterns is important because they help you identify potential upward movements in the market. When you spot these patterns at the right time, you can jump in early and take advantage of the rise before it becomes obvious to everyone else. Candlesticks are a visual reflection of market sentiment, and by learning to read them, you'll gain insight into the emotions driving the market, whether it's optimism, hope, or greed. Conclusion. In conclusion, bullish candlestick patterns are like signals from the market telling you that buyers are taking control, whether it's a bullish engulfing, hammer, or morning star. Each pattern has its own unique message about the market's psychology. By learning these patterns and using them in combination with other tools, you can start spotting high-probability trades and increase your chances of success in the market. Bearish candlesticks patterns signaling potential downward movement. What's up, traders? In this section, we're diving into bearish candlestick patterns. These are the signals that tell us when the market is likely to fall. If you're looking for selling opportunities or ways to profit from a market that's on the way down, then understanding bearish patterns is a must. So let's break it down in simple terms. And trust me, by the end of this video, you'll be spotting these patterns like a pro. What are bearish candlesticks? All right, first things first. Bearish candlesticks are simply candles that show a downward price movement. When you see a red or black candle, it means the price has moved from a higher point to a lower point, indicating that sellers are in control. This is a sign that the market could be heading lower. However, it's not just about the color of the candle itself. It's about the context in which it appears. Bearish candlestick patterns become more important when they appear after a strong uptrend. That's when you start thinking, hey, this might be a good time to sell or short the market. So, let's take a look at some of the most common bearish candlestick patterns and what they mean. So 1. Bearish engulfing pattern. The bearish engulfing pattern is one of the most powerful bearish signals. It happens when a small green candle, or bullish candle, is followed by a big red candle that completely engulfs the first one. Here's what this means. The first candle shows that buyers were in control. But the second candle completely wipes out all the gains from the first candle, showing that sellers have taken control and are pushing the price lower. If you spot a bearish engulfing pattern at the top of an uptrend, it could signal that the market is ready to reverse and move down. This is a key signal to look for when you're trying to catch a potential downtrend. 2. Shooting star pattern. Next up, we have the shooting star pattern. This one looks like a star with a small body at the bottom and a long wick at the top. The key takeaway here is the price opens low and rallies all the way up, but then closes back near the open. This indicates that buyers pushed the price up, but sellers quickly came in and drove the price back down. The shooting star shows that even though the buyers had control at some point, the sellers took over, pushing the price back down. This pattern is most effective when it appears at the top of an uptrend, signaling a possible reversal to the downside. 3. Evening star pattern. The evening star is another great reversal pattern that consists of 3 candles. The first candle is a big green candle, showing the uptrend. The second candle is a small candle. It could be a doji or small red-green candle, showing indecision in the market. The third candle is a big red candle, which completely engulfs the second candle and closes lower. This pattern signals a bearish reversal. It suggests that the buying momentum is slowing down, and the sellers are starting to take control, which could lead to a downtrend. If you spot this pattern at the top of an uptrend, it's a strong signal that the market may be about to turn downward. 4. Dark cloud cover pattern. The dark cloud cover pattern is a 2-candle pattern where the first candle is a big green candle, indicating the continuation of an uptrend. The second candle is a red candle that opens above the previous day's high, but then closes below the midpoint of the green candle. This pattern is significant because it shows that the buyers were in control initially, but the sellers came in strong, pushing the price below the previous high. The dark cloud cover suggests that the market could be losing steam and may start moving down. 5. Three Black Crows Pattern. The Three Black Crows is a powerful bearish pattern made up of 3 consecutive red candles. Here's what happens. Each red candle is long and closes lower than the previous candle. The 3 candles should be relatively close together, showing that the market is consistently moving lower with strong downward momentum. This pattern signals that the market is in a strong downtrend and the bears' sellers are firmly in control. If you see this pattern, especially after an uptrend, it's a good indication that the market might continue to fall. How to trade with bearish candlesticks. So, how do you actually trade with these bearish patterns? Here are a few tips to help you get started. Wait for confirmation. Don't just blindly sell because you see a bearish pattern. Wait for confirmation that the price is actually moving in the direction you expect. Combine with other indicators. Use tools like RSI or moving averages to confirm that the market is indeed turning bearish. Risk management. Just like with bullish patterns, always use stop losses and proper position sizing to manage your risk. Not every bearish pattern will lead to a perfect downtrend, so it's important to protect your capital. Why bearish candlestick patterns matter. Understanding bearish candlestick patterns is essential because they give you an early warning sign that the market might be about to reverse and head downward. When you spot these patterns at the top of an uptrend, it's like the market is telling you to prepare for a potential decline. The earlier you spot these patterns, the better you can position yourself to profit from the downturn. So, there you have it. Bearish candlestick patterns are a great way to identify potential downward moves in the market. Whether it's the bearish engulfing, shooting star, or 3 black crows, these patterns provide you with valuable insights into market sentiment and can help you spot profitable selling opportunities. Indecision candlesticks, candlesticks that suggest market uncertainty. We're going to talk about something that happens a lot in the market. Indecision candlesticks. You've probably seen them on your charts before. They look kind of strange, don't they? And they can really make you wonder what's going on in the market. Are the buyers in control, or are the sellers taking over? Well, indecision candlesticks are like a pause button in the market, showing that nobody really knows which direction it's going next. What are indecision candlesticks? All right, so indecision candlesticks are exactly what they sound like. They show uncertainty in the market. These candles typically have a small body and long upper and lower wicks. And they usually appear after a strong move, either up or down. What do they mean? Well, these candlesticks suggest that neither the bulls' buyers nor the bears' sellers are in control. The long wicks show that both buyers and sellers are trying to push the price in their direction. But by the end of the candle, the price settles back to the middle. This indicates that there is a lot of back and forth going on in the market, and the buyers and sellers are in a bit of a battle. When you spot these candlesticks, it's a warning sign that the market might be uncertain and a big move could be coming. The next candle will often tell you which direction the market is likely to go, up or down. Types of indecision candlesticks. There are 2 main types of indecision candlesticks that you'll often encounter in your trading. 1. Doji. The doji is the most common indecision candlestick, and it happens when the opening and closing prices are almost identical. The body is super small, and the upper and lower wicks can be long or short. The longer the wicks, the more uncertainty there is in the market. A doji after a strong uptrend suggests that the buying momentum might be slowing down. A doji after a strong downtrend suggests that the selling momentum could be fading. Pro tip: always keep an eye on where the doji is forming. It's more significant after a strong trend, especially at the top or bottom of a move. 2. Spinning top. The spinning top is another type of indecision candlestick. It has a small body like the doji, but the wicks are usually shorter. It suggests that there's some buying and selling activity, but neither side is able to dominate. A spinning top after an uptrend might signal that buyers are getting tired and that the trend might be losing strength. A spinning top after a downtrend might signal that sellers are losing control and a reversal could be coming. The size of the body and the wicks are important here. A larger body suggests a stronger sense of indecision, while a smaller body might just be a short pause in the market. When to pay attention to indecision candlesticks. Indecision candlesticks are especially important when they appear after a strong trend. Here's why. If the market has been moving up strongly and you see a doji or spinning top, it could signal that the buying pressure is starting to fade and a reversal or pullback might be coming soon. If the market has been dropping sharply, an indecision candlestick might signal that the selling momentum is starting to lose steam and a reversal to the upside might be near. These candles don't necessarily tell you which direction the market will move in next, but they definitely suggest uncertainty and that a big move could be on the horizon. So when you see one of these patterns, be ready for potential volatility. How to trade with indecision candlesticks. Now, how do you actually trade with these indecision candlesticks? Well, here are a few key tips. 1. Wait for confirmation. Don't jump into a trade just because you see an indecision candlestick. You need confirmation that the price is actually going to move in the direction you think. This could come from the next candle breaking out of the range or a pattern confirming the trend reversal. 2. Look for patterns. If you see a doji or spinning top after a big uptrend or downtrend, wait for the next few candles to confirm if the trend is indeed reversing. Sometimes, the market will consolidate for a bit before making its next move. Number 3. Use other indicators. Indecision candlesticks are powerful on their own, but combining them with other tools like RSI, moving averages, or support resistance levels will give you more confidence in your trade. 4. Risk management. As with any pattern, always manage your risk. Set your stop loss in a logical place and don't bet everything on one candle. The market can still go either way, so make sure your position size is right. Why indecision candlesticks matter. Indecision candlesticks are a sign of change. They show that the market is uncertain, and when combined with other indicators, they can help you spot potential trend reversals or consolidation phases. Understanding these candles is key because they help you prepare for big moves that might come next, and being prepared can make all the difference in your trading success. Conclusion. To wrap it up, indecision candlesticks like the doji and spinning top are clear signals of market uncertainty. They show that neither buyers nor sellers have full control, and they often appear at important points in the market. When you see one, don't just trade blindly. Wait for confirmation, use other tools, and always manage your risk. If you do that, you'll be better positioned to take advantage of the big moves that follow. Candlestick patterns, common patterns, and their significance. We're diving deep into one of the most important concepts for any day trader, candlestick patterns. Whether you're just starting or already trading, understanding these patterns is key to making better decisions and spotting trends in the market. So let's break it down. What are candlestick patterns? First things first, what are candlestick patterns? Well, each candlestick represents a specific time period. It could be a minute, hour, or day, depending on your chart settings. The pattern of candlesticks, when observed in a series, can reveal trader psychology, and they often act as signals for where the market might head next. Each candlestick has 4 key parts. Open, the price at the start of the period. Close, the price at the end of the period. High, the highest price reached during the period. Low, the lowest price reached. Why candlestick patterns matter. So why are these patterns so important? Well, they help you anticipate future price movements by analyzing market sentiment, meaning they tell you if the bulls, buyers, or bears sellers are in control. By identifying these patterns early, you can make smarter decisions and capitalize on potential opportunities. Common candlestick patterns. Now, let's jump into some of the most popular candlestick patterns you'll encounter in your trading journey. 1. Doji. The doji is one of the most common candlestick patterns. It happens when the open and close prices are nearly identical, creating a tiny body with long wicks on both sides. It signifies indecision. Buyers and sellers are both fighting, but neither has control. When to watch for it? A doji at the top of an uptrend could indicate the end of the trend, signaling a possible reversal. Same goes for a doji at the bottom of a downtrend. It could mark a potential trend reversal to the upside. Hack 2. Engulfing pattern. The engulfing pattern consists of two candlesticks. A bullish engulfing happens when a small red, bearish candle is followed by a larger green, bullish candle that completely engulfs the previous one. A bearish engulfing is just the opposite, when a small green candle is engulfed by a larger red one. Bullish engulfing. If this appears after a downtrend, it's a sign that buyers have taken control and an uptrend might be coming. Bearish engulfing. After an uptrend, this pattern suggests sellers are taking over, signaling a potential downtrend. 3. Hammer and hanging man. Both the hammer and hanging man look the same. They have a small body at the top and a long lower wick. What makes them different is the context in which they appear. Hammer appears in a downtrend and it signals a potential reversal to the upside. Hanging man appears in an uptrend and it suggests a potential reversal to the downside. It's a sign that buyers tried to push the price higher, but sellers stepped in and forced the price lower. 4. Morning star and evening star. The morning star and evening star are three candle patterns that indicate a trend reversal. Morning star. This happens after a downtrend and consists of three candles, a long red candle, followed by a small body, doji or small red, and then a long green candle. It suggests that the market is starting to shift and could move upwards. Evening star. This is the opposite. It appears after an uptrend and consists of three candles, a long green candle, followed by a small body, and then a long red candle. It signals that the uptrend might be losing steam and a downtrend could follow. 5. Shooting star. A shooting star looks similar to a hammer, but it appears at the top of an uptrend. It has a small body and a long upper wick. This suggests that buyers tried to push the price higher, but sellers took control and the price closed near the low. Significance. When you see a shooting star after an uptrend, it's a sign of potential reversal, and the market could start moving lower. 6. Bullish and bearish harami. The harami is another two-candle pattern, but it's the opposite of the engulfing pattern. The first candle is large, either green or red, and the second candle is smaller and completely contained within the range of the first. Bullish harami appears during a downtrend and signals that a reversal to the upside might happen. Bearish harami appears during an uptrend, suggesting that the trend might reverse and move downward. 7. Inside bar and outside bar. The second candle is completely inside the range of the first candle. It suggests consolidation, and when combined with breakout strategies, it can signal a potential trend continuation. Outside bar. The second candle is larger and completely engulfs the first one. It can signal strong momentum, either in an uptrend or downtrend, depending on the direction of the larger candle. How to trade using candlestick patterns. So, how do you trade these patterns effectively? Well, a few tips. 1. Always look at the bigger picture. Don't just focus on one candle. Always look at the trend, volume, and market context to understand the significance of a pattern. 2. Use confirmations. A pattern is much stronger when the next candle confirms the move. If you see a bullish engulfing, wait for the next candle to break higher to confirm the bullish trend. 3. Combine with other indicators. Don't rely solely on candlestick patterns. Combine them with other indicators like RSI, moving averages, and support resistance levels to make your trade decision stronger. Final thoughts. Candlestick patterns are like visual clues in the market, and when you learn to recognize them, they can give you a big advantage. They tell you where the market might be going and give you insight into the psychology behind the price movements. But remember, no single pattern is foolproof. Combine your knowledge of candlestick patterns with other strategies and always manage your risk. Chapter 7. Important day trading strategies. We're going to talk about the core day trading strategies that can supercharge your trading game. If you want to make profits and stay ahead of the market, these strategies are your blueprint for success. So, let's dive in. What are day trading strategies? Before we dive into the details, let's quickly define what day trading strategies are. Simply put, day trading strategies are methods that traders use to enter and exit the market within the same trading day. The goal is to take advantage of small price movements and profit off the short-term volatility in the market. Each strategy has its own set of rules, and understanding these strategies will help you identify which one suits your trading style. So, let's break down some of the most effective and popular day trading strategies. 1. Scalping. First up, we have scalping, one of the fastest and most aggressive day trading strategies. What is it? Scalping involves making dozens or even hundreds of trades in a single day to capture very small price movements. Traders use high leverage and aim for a small profit per trade, but they make many trades throughout the day. When to use it? This strategy works best in liquid markets with tight bid-ask spreads, like stocks or Forex. Scalpers rely on speed, so it requires quick decision-making, a solid understanding of market dynamics, and a fast internet connection. Pros and cons. Scalping can be highly profitable if done correctly, but it can also be risky due to the number of trades and quick market fluctuations. Plus, commissions and fees can eat into profits. 2. Momentum trading. Next, let's talk about momentum trading. What is it? Momentum trading is all about identifying stocks or assets that are showing strong movement in one direction, either up or down. Traders buy when they spot momentum building and sell when they see the trend start to weaken. When to use it? This strategy works best in fast-moving markets where you can spot trends early and ride the wave. Typically, momentum traders use tools like news, earnings reports, and technical indicators to find stocks with potential for big price moves. Pros and cons. The major advantage is the potential for huge gains when the trend is strong. However, the key challenge is identifying the right momentum early enough and avoiding reversal risks. 3. Breakout trading. Another highly popular strategy is breakout trading. What is it? A breakout occurs when the price breaks above a resistance level or below a support level with increased volume. Breakout traders buy when the price breaks above resistance and sell short when the price breaks below support. When to use it? This strategy works best in consolidating markets where the price is ranging in a narrow channel. Once the price breaks out of that range, it often leads to strong price movements in the breakout direction. Pros and cons. Breakout trading allows traders to capture strong moves early, but the risk lies in false breakouts when the price moves past resistance or support, but quickly reverses. Proper risk management is essential. Mean reversion. The mean reversion strategy is based on the assumption that prices tend to revert back to their average or mean over time. What is it? This strategy involves buying when the price has fallen too far below its average price and selling when it's risen too far above the average. It assumes that overextended prices will eventually return to their normal range. When to use it? It works best in range-bound markets, markets that aren't trending strongly up or down, but are instead moving in a sideways pattern. Traders use indicators like Bollinger Bands or moving averages to spot overbought or oversold conditions. Pros and cons. The advantage of mean reversion is that it takes advantage of market corrections, but the risk comes from trends continuing in one direction for longer than expected, making it hard to predict reversals. Hack 5. Gap and go strategy. Have you ever seen a stock price gap up or down after hours? That's what the gap and go strategy focuses on. What is it? Gaps occur when a stock opens at a price that is significantly different from the previous day's closing price. Gap and go traders identify stocks with large gaps at market open and trade in the direction of the gap. This strategy is often used on stocks that have news or events driving the gap. When to use it? The gap and go strategy is great for trading stocks with high volatility and big news events. These stocks tend to have strong moves after the gap, either continuing in the gap's direction or correcting. Pros and cons. The key benefit is that you can capitalize on large price movements right at market open. However, gaps can also quickly fill out, meaning prices could reverse after a brief initial move. Being quick and managing risk is crucial. 6. Trend following. The trend following strategy is based on the idea that price trends will continue for a certain period. What is it? Trend following involves buying in an uptrend and selling short in a downtrend. Traders use technical indicators, like moving averages, to identify when a trend is starting and place trades in the direction of the trend. When to use it? This strategy works well in strong trending markets, whether up or down. The goal is to ride the trend for as long as possible, only exiting when the trend shows signs of reversing. Pros and cons. The major advantage is that you can capture large moves when the trend is strong. But trends can sometimes be short-lived, and if you don't identify a reversal early enough, you might face losses. 7. News-based trading. Finally, we have news-based trading, one of the most reactive strategies you can use. What is it? News-based trading involves trading based on market-moving news. This could include earnings reports, geopolitical events, or economic data releases. Traders act quickly on the news to capitalize on volatility. When to use it? This strategy works best when major market-moving events occur. Traders need to act quickly and be aware of the risks, since the market can move sharply in reaction to news. Pros and cons. The advantage of news trading is the potential for big profits when a market reacts strongly to the news. However, it can also be highly risky because the market's reaction may be unpredictable. Wrapping up. So there you have it. Saw 7 key day trading strategies that can help you take your trading to the next level. Each strategy has its own strengths and weaknesses, so it's important to choose one that aligns with your trading style, risk tolerance, and market knowledge. Whether you're scalping, trading breakouts, or riding trends, always remember that practice makes perfect. Test these strategies with paper trading before you commit real money, and don't forget to manage your risk. The key to consistent profits is being disciplined and sticking to a strategy that works for you. Trade management and position sizing. First off, what do we mean by trade management? Well, it's the process of handling your trades once they're open. It's about deciding when to exit, adjust stop losses, and lock in profits while managing the risk. And position sizing is all about determining how much of a particular asset you should buy or sell in a trade to stay within your risk tolerance. Let's break down both of these concepts step by step. 1. What is position sizing? Position sizing is the amount of capital you allocate to each trade. It's a crucial part of your risk management strategy. You can have the best trading strategy in the world, but if your position size is too large, you can wipe out your account with a few bad trades. Why is it important? Well, the goal is to risk only a small percentage of your trading capital on each trade. Let's say you're willing to risk 1% of your account per trade. If you have a $10,000 account, you're willing to lose $100 on any single trade. By keeping your risk consistent, you avoid big drawdowns in your account. How do you calculate it? You determine your stop loss, the amount of loss you're willing to take if the trade goes against you, and then calculate the position size based on that. For example, if you're risking $100 on a trade and the stop loss is $2 away from your entry price, you would buy 50 shares. $100 risk × $2 stop loss equals 50 shares. 2. How to manage your trades. Now that we know how to size positions properly, let's talk about how to manage your trades effectively once they're live. Stop losses and take profits. As a trader, always set stop losses and take profit orders. This helps you control your risk and ensures that you don't get too emotional during the trade. A stop loss automatically closes your trade if the price moves against you beyond a certain point. A take profit order locks in profits when the price hits your desired target. Trail your stop. One smart technique to protect your profits is trailing your stop loss. As the price moves in your favor, you move your stop loss up or down in the case of a short, to lock in profits. For example, if you're up $100 on a trade, you can trail your stop to $50, ensuring that no matter what happens, you're walking away with at least $50 profit. Adjusting position size based on market conditions. As a trader, you can't always use the same position size. The market's volatility will influence how much capital you risk. If the market is more volatile, you might want to take a smaller position size to reduce the risk. On the flip side, in less volatile markets, you can increase position size a bit while still maintaining that same risk management principle. 4. Scaling in and out of trades. Another technique that can help optimize trade management is scaling in and out of positions. This means you don't have to enter or exit all at once. Instead, you can break your position into parts and enter or exit them gradually as the market moves. Scaling in. This means adding to your position as the trade moves in your favor. For example, if the stock breaks out, you might add more shares to your position to capitalize on the momentum. Scaling out. This is the opposite. As the price moves in your favor, you can exit parts of your position to lock in profits. This helps you take profits along the way while still having some exposure if the trade continues to move favorably. 5. Managing risk with a fixed risk-to-reward ratio. An essential part of position sizing and trade management is setting a fixed risk-to-reward ratio. A common ratio used by many traders is 1:3, meaning you're willing to risk $1 to potentially make $3 on a trade. By sticking to a consistent risk-to-reward ratio, you ensure that even if you lose more trades than you win, you can still be profitable in the long run. Over time, if you maintain a good win rate with a favorable risk-to-reward ratio, you'll start to see consistent profits. 6. Avoid overtrading. One final tip is to avoid overtrading. A lot of traders get excited and make too many trades, thinking they have to trade all the time to make money. But the reality is, quality over quantity matters in day trading. Stick to the best setups that meet your strategy criteria and avoid entering trades just for the sake of it. In summary, trade management and position sizing are absolutely critical to long-term success in trading. By managing the amount of capital you risk per trade and sizing your positions appropriately, you give yourself the best chance of success. Always size your positions based on your risk tolerance. Use stop losses and take profits to manage trades. Scale in and out of trades to maximize profits. Stick to a fixed risk-to-reward ratio and avoid overtrading. When you get this right, you'll be able to stay in the game even when the market's unpredictable and keep your capital safe while maximizing your returns. All right, let's dive into one of the most popular strategies used by day traders, the ABCD pattern. This strategy is fantastic for identifying trend continuations. And if you're looking to catch big moves in the market, this could be a game changer for you. What is the ABCD pattern? The ABCD pattern is a simple but effective way to spot a potential trend continuation. It's based on the idea that prices move in waves, and this pattern helps you identify those waves to enter trades at the right time. Essentially, it shows us where the price is likely to keep moving in the same direction, giving us an opportunity to ride the trend. Here's how it works. Point A is the starting point of the trend. This is where the price begins to move in a particular direction. Point B is where the price pulls back a bit, creating a temporary dip or retracement. Point C is the point where the price reverses again and begins to move in the direction of the original trend. Point D is where the price continues the trend, and this is the point where you're looking to enter the trade. How to spot an ABCD pattern. 1. Identify the trend. The first thing you need to do is identify the overall trend. This pattern works best when there is an existing trend in the market, either upwards or downwards. 2. Wait for the pullback, B. After identifying the trend, you'll wait for the price to pull back to a point where it starts to reverse. This is point B. 3. Look for the reversal, C. After the pullback, you'll be waiting for the price to start moving in the direction of the trend again, which is point C. This is your signal that the trend is likely going to continue. 4. Confirm the entry D. The final step is confirming that the price is indeed continuing in the direction of the trend, and this happens at point D. This is your entry point for the trade. It's the sweet spot where you want to jump in and ride the wave. Why does the ABCD pattern work? The ABCD pattern works because of market psychology. In a trending market, people who miss the initial move often wait for a pullback, which creates that temporary dip at point B. Once the price starts moving up or down in a downtrend again, traders hop on, pushing the price further in the direction of the trend. So, when you spot this pattern, you're essentially jumping in at the right moment when the trend is about to accelerate again. It's a powerful strategy for trend continuation trades. How to trade the ABCD pattern. 1. Entry point D. Once the price hits point D, that's your cue to enter the trade. You're entering in the direction of the existing trend. 2. Stop loss. Place your stop loss below point B if you're going long or above point B if you're shorting to protect yourself in case the market moves against you. This ensures you're not risking more than you're comfortable with. 3. Profit target. As for your profit target, many traders use the distance from point A to B and then project that same distance from point C to get a potential target. For example, if point A to B is 1 point, you would expect point D to move at least 1 point from C. 4. Exit strategy. When the price reaches your target or shows signs of reversal, it's time to exit the trade. You've captured the majority of the move. Tips for maximizing the ABCD pattern. Confirmation is key. Don't just jump in as soon as you see point C. Wait for confirmation that the price is actually moving in the direction of the trend again. This could be through candlestick patterns, indicators, or just market momentum. Risk management. Make sure to stick to your risk-to-reward ratio and never risk more than you're willing to lose. Use stop losses to minimize potential losses if the trade doesn't go in your favor. Combine with other indicators. While the ABCD pattern is powerful on its own, combining it with other indicators like moving averages or RSI can give you even more confidence in your trades. Wrapping it up. The ABCD pattern is an amazing tool for identifying trend continuations, and once you master it, you'll be able to spot high-probability trades with confidence. Here's a quick recap. 1. Look for a strong trend. 2. Wait for the price to pull back to point B. 3. Watch for the reversal at point C. 4. Enter the trade at point D with a stop loss in place. 5. Take profits at a target based on the initial move's distance. With this strategy, you're essentially positioning yourself to catch the best part of the move and maximize your potential profits while minimizing risk. All right, traders, let's jump into strategy 2, bull flag momentum. This is an awesome strategy for exploiting short-term momentum breakouts. And if you love catching those powerful trend continuation moves, this strategy is for you. What is a bull flag? So what exactly is a bull flag? In simple terms, a bull flag is a chart pattern that shows a brief consolidation in an uptrend, followed by a continuation of the trend. Think of it like a flagpole, the initial uptrend, with a flag, the consolidation phase, before the price hot breaks out again, continuing its upward momentum. In other words, the bull flag pattern is all about spotting a pause in an otherwise strong uptrend before the price breaks out to continue the move higher. How to spot a bull flag. 1. Look for a strong uptrend. First things first, you need to identify a strong uptrend. This could be a sharp, quick move where the price shoots up, creating the flagpole part of the pattern. The steeper, the better. 2. Wait for the consolidation, the flag. After the price has shot up, it will typically consolidate for a short period. This forms the flag part of the pattern. The consolidation usually happens at a slight downward angle or moves sideways as the price takes a breather. 3. The breakout. The key moment is when the price breaks out of the flag to the upside. This is the point where you want to enter the trade, anticipating the resumption of the bullish momentum. Why does the bull flag work? The bull flag works because it's a sign of market strength. When the price makes a strong move up, the flagpole, then consolidates for a bit, the flag, traders often view this as a pause or rest before the price continues higher. This consolidation happens because there's some profit taking or temporary indecision, but the overall demand for the asset is still there. Once the price breaks out of the flag, the momentum resumes, pushing the price higher. How to trade the bull flag momentum. 1. Entry point, the breakout. The key to trading the bull flag is waiting for the breakout. This is the moment the price breaks above the top of the flag, signaling that the uptrend is resuming. You'll want to enter the trade right after this breakout happens. This is when the momentum is likely to pick up and drive the price higher. 2. Stop loss. Always use a stop loss to protect your trade. Place your stop just below the flag or below the recent swing low within the flag. This helps minimize risk in case the breakout turns out to be a false signal. 3. Profit target. As for your profit target, a great way to set it is by measuring the length of the flagpole. Take the distance from the bottom of the flagpole to the top and project that same distance from the breakout point. This gives you an estimate of where the price could go after the breakout. For example, if the flagpole is 5 points tall, expect the price to move up at least 5 points after the breakout. Keep in mind, it could go even further, so you may want to trail your stop to lock in profits as the price continues to rise. Key tips for maximizing the bull flag momentum strategy. Wait for confirmation. Don't jump in the second you see a flag. You need confirmation that the price is actually breaking out. Look for a strong volume surge as the price breaks the flag, as this indicates that there's real momentum behind the move. Volume matters. Always pay attention to volume. For a bull flag to be valid, you need to see high volume during the breakout. If the breakout happens on low volume, it could be a false signal, and the price might fall back into the flag. Risk management. As always, make sure you are managing your risk properly. Stick to your risk-to-reward ratio, and don't risk more than you're comfortable with on any single trade. The stop loss is your safety net if things don't go according to plan. Combine with other indicators. While the bull flag is a powerful pattern on its own, using other indicators like RSI or moving averages can give you more confidence in your trade. For example, if the RSI is in an overbought condition, it might signal that the breakout could be losing momentum. So be cautious. Wrapping it up. The bull flag momentum strategy is a fantastic way to capture big moves in the market after a brief consolidation. Here's a quick recap. 1. Look for a strong uptrend, the flagpole. 2. Wait for the consolidation to form, the flag. 3. Wait for the breakout above the flag. 4. Enter the trade and place your stop loss below the flag. 5. Set your profit target using the length of the flagpole. 6. Manage your trade with volume confirmation and risk management. This strategy is all about timing and getting in just when the momentum kicks back in. If you catch that breakout, you can ride the bullish trend for some fantastic profits. So, keep an eye out for bull flag patterns in your charts, and when you see them, you'll know exactly what to do. All right, traders. Now it's time to dive into strategies 3 and 4. Reversal trading. These strategies are all about identifying and trading market reversals. When the market changes direction after trending in one way for a while, it's all about spotting when the trend is about to flip. And if you get it right, you could potentially catch a big move. What is reversal trading? Reversal trading focuses on finding those key points in the market when prices stop going up or down and change direction. Unlike trend-following strategies, where you ride the wave of the trend, reversal trading aims to catch the turning points. These turning points can be incredibly profitable because you're getting in early before the market really starts to move in the opposite direction. Strategy 3. Identifying reversals with candlestick patterns. One of the most common ways to spot reversals is through candlestick patterns. These patterns provide clues about potential reversals in the market. Let's go over some of the most popular ones you need to keep an eye on. 1. Engulfing patterns. A bullish engulfing pattern happens when a small red candle is followed by a large green candle that completely covers or engulfs the previous one. This signals that buyers are stepping in, and a reversal to the upside could be coming. On the flip side, a bearish engulfing pattern shows that sellers are taking control and a downward reversal might be on the way. 2. Hammer candles. The hammer is a single candlestick pattern that occurs at the end of a downtrend. The candle has a small body and a long lower wick. It signals that sellers pushed the price lower, but by the end of the session, buyers stepped in, pushing the price back up. This can indicate a potential reversal to the upside. 3. Shooting star. The shooting star is the opposite of the hammer. It happens at the end of an uptrend, and the candlestick has a small body and a long upper wick. This suggests that buyers tried to push the price higher, but by the end of the session, the sellers took control, signaling a potential reversal to the downside. These candlestick patterns can help you spot reversal points in the market, but always remember that candlesticks don't tell the whole story. You should combine them with other indicators or price action for confirmation. Strategy 4. Using support and resistance for reversals. Another way to spot reversals is by identifying key support and resistance levels. These are price levels where the market has previously struggled to move past, and price reaches them again, it may reverse. 1. Support. This is a price level where an asset's price tends to find buying interest. Think of it like a floor for the price. When the price hits support, it often bounces back up. But if it breaks through support, it could signal a further decline. So if the price comes down to a support level and then starts to rise, you may be looking at a reversal to the upside. 2. Resistance. Resistance is the opposite. It's like a ceiling. When the price approaches resistance, it often struggles to break through, and a reversal downward can happen. However, if the price breaks above resistance, it can signal a bullish reversal. So, watch for price to reach these key levels. If it reverses off them, you could have a high probability trade for a potential profit. How to trade reversals. Here's a step-by-step on how to trade reversals effectively using these strategies. 1. Spot the trend change. The first thing you need to do is recognize that the market is changing direction. Look for those candlestick patterns or key levels like support and resistance that suggest the price is about to reverse. 2. Wait for confirmation. Patience is key. Don't rush into trades just because you think a reversal is coming. Wait for confirmation that the price is actually reversing. This could be a candlestick pattern forming at a key level or a break of trend line or support resistance level. 3. Enter the trade. Once you see confirmation, it's time to enter. A common entry point for reversals is after a breakout from support or resistance. Another entry point is right after a candlestick reversal pattern forms, such as an engulfing or hammer candle. 4. Set stop loss. Always manage your risk. Place your stop loss just beyond the recent high or low, depending on whether you're taking a long or short position. This ensures that if the reversal doesn't happen, your losses are limited. 5. Profit target. A good rule of thumb is to set a profit target at the next key level of support or resistance. If you're trading a bullish reversal, target the next resistance level. If it's a bearish reversal, target the next support level. Why reversal trading works? Reversal trading works because the market is never linear. It doesn't always keep going up or down forever. There are natural points where trends change, and reversal traders are the ones who capitalize on those changes. By using candlestick patterns, support resistance levels, and confirming with other indicators, you can increase your chances of catching high probability reversals. And the best part is, you don't have to chase the trend all the way to the top or bottom. You just need to get in when the market turns. Tips for successful reversal trading. Don't jump the gun. It's easy to get excited about a potential reversal, but wait for confirmation before entering. Make sure the pattern or support resistance break is strong. Risk management. Reversal trades can be tricky, so make sure your stop loss is in place. If the market keeps moving against you, don't let your losses get out of hand. Combine strategies. Reversal trading is powerful on its own, but it works even better when combined with other strategies. Use indicators like RSI or MACD to confirm whether the market is overbought or oversold, which can help you spot potential reversals. Wrapping up. So, there you have it. Reversal trading is an exciting way to catch market turns and capitalize on price reversals. Whether you're using candlestick patterns or support and resistance levels, the goal is the same. Spot the turning point and trade it for a nice profit. All right, traders, let's dive into Strategy 5, Moving Average Trend Trading. This strategy is all about using moving averages to help you identify and trade trends in the market. It's a classic approach that traders use to filter out noise and focus on the bigger picture, and it's super effective once you understand how it works. What are moving averages? First things first, let's talk about what a moving average is. A moving average, MA, is a tool used to smooth out price data over a set period of time. It's like drawing a line that shows the average price of an asset over a specific time, so you get a clearer picture of the market trend without all the day-to-day fluctuations. There are two main types of moving averages you'll use in trend trading. One, simple moving average, SMA. This is the most basic type of moving average. It calculates the average price of an asset over a specific number of periods. For example, a 50-period SMA takes the average of the closing prices for the past 50 bars, whether that's minutes, hours, or days, depending on your time frame. Number 2, exponential moving average, EMA. This one is similar to the SMA, but it gives more weight to recent prices, making it more responsive to current price movements. This is why many traders prefer the EMA, because it reacts faster to market changes than the SMA. Now let's see how these moving averages can help you trade trends. How moving averages help identify trends. Moving averages are like the guides for identifying market trends. Here's how they work. 1, bullish trend. If the price is above the moving average, the market is generally in an uptrend. This shows that on average, the price is increasing. If the moving average is sloping upward, that's a confirmation that the market is in a strong bullish trend. 2, bearish trend. If the price is below the moving average, it's a sign that the market is in a downtrend. This means that, on average, prices are going lower, and if the moving average is sloping downward, that's your confirmation of a bearish trend. Using moving averages for entries. Now, let's get into how you can use moving averages to enter trades. 1. Crossovers. One of the most popular strategies with moving averages is looking for crossover points. This is when a shorter-term moving average crosses over a longer-term moving average, or vice versa. Here's how it works. Bullish crossover, golden cross. This happens when a shorter-term moving average, like the 50-period MA, crosses above a longer-term moving average, like the 200-period MA. This is a strong signal that an uptrend is starting, and it's time to consider a buy. Bearish crossover, death cross. On the flip side, a bearish crossover happens when a shorter-term MA crosses below the longer-term MA. This signals that a downtrend is beginning, and it might be time to sell or look for shorting opportunities. 2. Pullbacks in a trend. Sometimes, price can temporarily pull back against the trend, which can be a great opportunity to get in at a better price. If the price is in an uptrend and temporarily pulls back to the moving average, it's often seen as a support level. If the price bounces off the moving average, you can consider entering the trade with the trend. 3. Moving average as dynamic support resistance. In trending markets, moving averages act as dynamic support in uptrends and resistance in downtrends. So during a bullish trend, if the price pulls back to the moving average and bounces, that's your cue to buy. On the other hand, during a bearish trend, if the price approaches the moving average and fails to break through, you can look for a sell opportunity. Setting up your moving average trend strategy. Here's how you can set up your moving average trend trading strategy. 1. Choose your moving averages. Most traders use the 50-period SMA or EMA for short-term trends and the 200-period SMA or EMA for long-term trends. The 50-period MA shows the intermediate trend, while the 200-period MA shows the bigger picture. Using both helps you see both the short and long-term trends. 2. Identify the trend. Look at the position of the price relative to the moving averages. If the price is above both the 50 and 200 EMA, the trend is up. If the price is below both the 50 and 200 EMA, the trend is down. 3. Wait for the crossover. When you see a crossover between the moving averages, that's your signal to act. A bullish crossover signals a buy, and a bearish crossover signals a sell. 4. Confirm with other indicators. Moving averages are powerful, but they work even better when used with other technical indicators, like the Relative Strength Index, RSI, or MACD. For example, if you see a bullish crossover and the RSI is below 30, indicating the stock is oversold, it's a strong buy signal. 5. Set stop loss and take profit levels. After you enter the trade, use the moving average as a level for setting your stop loss and take profit targets. In an uptrend, your stop loss can go just below the moving average, and in a downtrend, place your stop loss just above the moving average. Why moving average trend trading works. Moving averages are a lagging indicator, meaning they are based on past price data, but they help smooth out the noise in the market, making it easier to spot the overall trend. Trends are one of the most important concepts in trading because the trend is your friend, and by using moving averages, you can ride that trend for as long as it lasts. Key takeaways. Moving averages help you identify trends and filter out noise. Use crossover signals to enter trades, golden cross for buys, death cross for sells. In trending markets, the moving average acts as dynamic support or resistance. Combine moving averages with other indicators for better trade confirmation. Risk management is crucial. Always use stop loss and take profit levels to protect your trades. So there you have it. Moving average trend trading is a simple yet powerful strategy that can help you ride trends and make consistent profits in the market. Remember, it's all about getting in with the trend and using moving averages as your guide. Keep practicing, stay disciplined, and you'll be riding those market trends like a pro in no time. All right, let's dive into Strategy 6, VWAP trading. If you're ready to take your trading to the next level, then VWAP, or volume-weighted average price, is a strategy you'll want to master. VWAP is a powerful tool that helps traders spot key levels in the market, and it's all about understanding price action in relation to volume. What is VWAP? So what exactly is VWAP? Well, it's an indicator that shows the average price a stock has traded at throughout the day, weighted by volume. It's like a moving average, but instead of just averaging the price, it gives more importance to the price levels with higher trading volume. The result? A price that truly reflects the average price at which most shares were traded, factoring in both price and volume. VWAP formula. FRAC price times volume. This gives you a price level that incorporates both price movement and volume, which helps you see where the bulk of trading has happened throughout the day. Why VWAP is important. VWAP is widely used by institutional traders and day traders alike because it offers a real-time average that's influenced by actual market activity. It tells you if a stock is trading above or below its typical price for the day, and traders can use this information to make better decisions. Above VWAP. If the price is above the VWAP, it generally indicates that the stock is in an uptrend and buyers are in control. Below VWAP. If the price is below the VWAP, it signals that the stock is in a downtrend and sellers are likely dominating. How to use VWAP in your trading. Now that we understand what VWAP is, let's talk about how to use it in your trading. 1. Trend confirmation. When the price is above VWAP, the market is typically in an uptrend. You can look for buying opportunities. When the price is below VWAP, the market is in a downtrend, and you can look for shorting opportunities or consider selling. VWAP helps you confirm the trend direction for the day, so you're always trading with the flow of the market. VWAP for entries and exits. The real power of VWAP comes when you use it to time your entries and exits during the day. Here's how you can do that. 1. Entering a trade. If the price is below VWAP and starts to move above it, that could be a sign of a reversal or an uptrend beginning. This is often a buy signal. If the price is above VWAP and starts to move below it, it might be a signal of a reversal to the downside. So this could be a sell or short signal. 2. VWAP as dynamic support and resistance. In an uptrend, VWAP can act as a support level. If the price pulls back to VWAP and bounces back up, that's a potential buy signal. In a downtrend, VWAP can act as resistance. If the price rallies up to VWAP and gets rejected, that could be a potential sell signal. VWAP also acts as a dynamic level of support or resistance, which means you can use it to adjust your stops and take profits as the price fluctuates throughout the day. VWAP trading strategies. Now let's look at how to build a strategy using VWAP. 1. VWAP bounce strategy. This is one of the simplest and most popular strategies. When the price is trending above VWAP and pulls back to it, traders will look for the price to bounce off VWAP. This bounce often happens with increased volume, and it's considered a buy signal. In the opposite case, when the price is below VWAP and rallies up to VWAP, a rejection at this level can be a short signal. 2. VWAP breakout strategy. When the price breaks above VWAP during an uptrend, this can signal a strong move to the upside. Traders can enter long positions and look for a continuation. Conversely, if the price breaks below VWAP during a downtrend, it signals that the downward move is likely to continue, and traders can enter short positions. Why VWAP works? VWAP is often called the institutional trader's favorite tool because it reflects real market behavior. Big players like hedge funds and banks use VWAP to benchmark their trades and make decisions. So when the price is above VWAP, you're generally following what the big players are doing. And when the price is below, it can show that the institutions are not buying. Tips for using VWAP effectively. 1. Combine with other indicators. VWAP is great on its own, but it works even better when you combine it with other indicators like the Relative Strength Index, RSI, or MACD. For example, if the price is above VWAP and RSI is showing that the stock is overbought, you might want to avoid buying. Or if the price is below VWAP and RSI shows an oversold condition, it could be a good time to buy. 2. Watch for high volume. VWAP works best when you have high trading volume. So if you see a strong volume spike in the direction of the trend, either above or below VWAP, it's a good signal that the move could continue. 3. Don't ignore market news. Always keep an eye on market news. VWAP is a fantastic tool, but external factors like earnings reports or economic data releases can cause the market to behave unpredictably, even with VWAP indicating a trend. Key takeaways. VWAP is a volume-weighted average price that gives you an average price based on both price and volume. Use VWAP to confirm trends. Price above VWAP means an uptrend. Price below VWAP means a downtrend. Look for VWAP bounce and VWAP breakout strategies to time your entries and exits. VWAP acts as dynamic support in an uptrend and resistance in a downtrend. Combine VWAP with other indicators and watch for high volume to make the most out of your trades. All right, let's break down strategy 7, support or resistance trading. This is a classic strategy, and for good reason. Support and resistance are some of the most reliable price levels in any market. Whether you're trading stocks, Forex, or even crypto, understanding these levels can make a massive difference in your trading success. What are support and resistance? So, let's start with the basics. What do we mean by support and resistance? Support is a price level where a downtrend can be expected to pause or reverse. Think of it as the floor of the market. When the price gets to this point, it has a hard time falling further because there are buyers who want to enter the market here. Resistance, on the other hand, is the opposite. It's the price level where an uptrend is likely to pause or reverse because there are sellers waiting to sell at this level. Imagine it as the ceiling, where prices hit a barrier and struggle to push higher. Why are support and resistance important? Support and resistance are psychological levels in the market. They represent areas where traders have previously bought or sold, so they become key zones where the market reacts. Traders use these levels to enter and exit positions, so understanding them helps you align your trades with market psychology. How to trade support and resistance. Let's talk about how you can trade these levels. 1. Support trading buying. When the price approaches a support level, you might look to buy. The idea is that the price will likely bounce off this level and head back up. This is a buy signal. A good rule of thumb is to enter a long position when the price touches or comes close to a support level and shows signs of reversing, like a bounce or a candlestick pattern forming. 2. Resistance trading, selling. When the price reaches resistance, you might look to sell. The idea is that the price will face selling pressure here and drop back down. A good strategy is to wait for the price to approach resistance and show signs of rejection, like a candlestick pattern or price action indicating a reversal. If you see this, you can enter a short position. Breakouts and retests. Now here's the twist. What happens if the price breaks through support or resistance? This is where the concept of breakouts and retest comes into play. 1. Breakout above resistance, bullish signal. If the price breaks above a resistance level with strong volume, it could indicate that the price will continue higher. This is called a breakout, and it's often a bullish signal. Traders will look to buy the breakout. After the breakout, the previous resistance level often acts as support. If the price retests this level and bounces, that's a strong confirmation that the trend is continuing, and you can enter long. 2. Breakdown below support, bearish signal. If the price breaks below support with strong volume, it's a bearish signal. The price is likely to continue downward, so traders will look to short the stock. After the breakdown, the previous support level now acts as resistance. If the price retests this level from below and faces rejection, it confirms the bearish trend, and you can enter short. Key tips for trading support and resistance. 1. Look for confluence. Confluence means combining multiple signals to increase the probability of success. For example, if a support level coincides with a moving average or a trend line, it's a stronger level because you have more factors supporting that trade. Similarly, if resistance aligns with a previous high or a Fibonacci level, it gives you more confidence in that price point. 2. Pay attention to volume. Volume is a key indicator when trading support and resistance. When a price breaks through a level with high volume, it's more likely to continue in the direction of the breakout. If a price breaks a level with low volume, it might be a false breakout, and you should be cautious. 3. Use price action for confirmation. Sometimes the price might hit a support or resistance level and seem like it will reverse, but you'll want confirmation before jumping in. Look for candlestick patterns or price action that suggest the price will actually reverse and not just keep moving in the same direction. 4. Watch for multiple touches. The more times a price has touched a support or resistance level, the stronger that level becomes. So a support level that has been touched multiple times is likely to hold up better than one that's only been tested once. Common support and resistance patterns. Double top. This is when the price hits a resistance level twice, fails to break it, and then reverses. It's often a sign that the price will start heading downward. Double bottom. This is when the price hits a support level twice, bounces off it, and then moves higher. It's a sign that the price might begin trending up. Head and shoulders. This pattern forms at a resistance level and signals that the price will start moving lower after the break of the neckline. Inverse head and shoulders. This is the opposite and signals a trend reversal to the upside. Why support and resistance trading works. This strategy works because market psychology plays a huge role in price movements. People have a tendency to react to certain price levels, whether it's based on previous trades or just psychological factors like round numbers, e.g. $100 or $50. When the price reaches these levels, many traders make decisions based on past behavior, creating a self-fulfilling prophecy. Final takeaways. Support is where prices stop falling, and resistance is where prices stop rising. Trade long when the price bounces off support, and trade short when the price faces rejection at resistance. Pay attention to breakouts and retests of support and resistance levels. Use volume and price action to confirm your trades. Look for multiple touches of support or resistance to strengthen your strategy. And that's how you can use support and resistance trading to identify key price levels and execute trades with more confidence. Let's dive into Strategy 8, red to green trading. If you're someone who loves spotting reversals, this strategy is going to be a game changer for you. It's all about identifying stocks that are showing weakness, but then quickly reversing to show strong momentum. It's a strategy that capitalizes on those explosive moves, and it's all about timing. What is red to green trading? In the simplest terms, red to green trading is when a stock starts the day down, red, and then shifts to show upward momentum, green. It's a reversal play where you're betting on a short-term bounce from a previously weak stock. So imagine this. The stock is losing value in the early market hours, but suddenly it shows signs of strength and starts climbing. This is when you jump in, riding the uptrend that follows the reversal. Sounds interesting, right? How does it work? Here's the step-by-step process. 1. Stock opens red. The stock starts the day down. It could be because of bad news, an overall market dip, or simply a stock that's been trending downward. This is what we call the red part. Traders might already be jumping into short positions because the stock seems weak. 2. Watch for a reversal. The key to red to green is to spot the moment of reversal. At some point during the day, the stock starts to show signs of recovering. It might form a support level, or a candlestick pattern might suggest the stock is ready to move higher. Often, this is where traders get squeezed. Those who were shorting the stock are now in trouble as the price rises, pushing them to cover their positions, which causes the price to climb even faster. 3. Confirm the green. When the stock goes from red to green, meaning it moves above its opening price, that's your buy signal. The momentum is shifting from down to up, and you want to capitalize on that. Make sure to wait for confirmation. This could be a breakout above a recent high, a key moving average crossing, or a volume spike. You don't want to jump in too early before the momentum is clear. 4. Ride the uptrend. Once the stock is in the green zone, it's time to buy and ride the wave. As the stock continues its upward movement, you can manage the trade by adjusting stop losses and taking profits at key levels. Why does it work? The reason red to green works so well is because of market psychology. When a stock starts off the day in the red, there's often a negative sentiment surrounding it. But if that stock then shows signs of strength, it catches traders off guard. The reversal creates short squeeze opportunities where short sellers get trapped and are forced to buy back the stock, which drives the price even higher. It's also a sign of market resilience. When a stock can shake off negative pressure and start trending up, it can continue to move higher for the rest of the day. How to trade red to green. 1. Setup criteria. Look for stocks that are down in the pre-market or early in the day. These are your red stocks. Watch for a turnaround. Look for candlestick patterns like hammer or bullish engulfing that indicate the stock is trying to reverse. Confirm the reversal with key indicators like a break above previous highs, volume spikes, or the stock breaking through a key resistance level. 2. Entry point. Enter the trade once the stock moves from red to green and starts pushing above its opening price. Use stop-loss orders just below the recent low or the area where the stock was previously failing. 3. Exit strategy. Once the stock is in the green zone and starts to climb, you can either scale out of the position or hold it until it starts to lose momentum. Set profit targets at key resistance points, such as previous highs or key moving averages. What to watch out for? As with any strategy, there are a few things to keep in mind. 1. False reversals. Not every red to green move will be a winner. Sometimes the stock may seem to recover, but then fail, dropping back down again. Always make sure there's a clear signal before entering the trade. 2. Volume matters. For the red to green move to be reliable, there should be strong volume. Without sufficient volume, the move might not sustain itself. 3. Market context. If the overall market is in a downtrend, you might see more false reversals, so make sure you are aware of the broader market conditions. Red to green works best in bullish markets. Tips for success. Use hotkeys for quick execution. Since you're trading short-term moves, having hotkeys set up for quick entries and exits can give you an edge. Always confirm with indicators. Using indicators like the Relative Strength Index, RSI, or moving averages can help confirm the momentum before you make your trade. Don't chase moves. Sometimes the stock will reverse and move higher quickly. Be cautious not to chase the price. Wait for confirmation and a pullback to get a better entry. Why red to green trading is powerful. When you master red to green trading, you're essentially capitalizing on momentum shifts. You're catching stocks at a moment of change, riding that wave of energy as the stock turns from weakness to strength. It's an exciting, action-packed strategy that can lead to fast profits if you manage it well. Final thoughts. Look for stocks that are down in the early market hours. Wait for the reversal as the stock shifts from red to green. Enter when the price starts climbing and confirm with key indicators. Ride the uptrend, but use stop losses to manage risk. This strategy is great for traders who like to catch reversals and profit from momentum shifts. So, if you're into fast-paced trading, red to green could be your go-to move. Let's talk about Strategy 9, opening range breakouts, a super popular strategy used by many day traders to capitalize on the initial movements after the market opens. If you love trading early, this one's for you. What is opening range breakout? Opening range breakout, ORB, is all about trading the first few minutes of the trading day. The concept is simple. After the market opens, there's usually a brief period where the price of a stock moves within a certain range, forming an opening range. This range is made up of the high and low of the stock's price action in the first few minutes after the market opens. Once the stock breaks above the high or below the low of that range, it's considered an opening range breakout. The idea is to enter the trade early and ride the momentum as the stock starts trending in one direction. How does opening range breakout work? 1. Identify the opening range. The first step is to wait for the market to open and let the stock move a little bit. During the first 5 to 15 minutes of trading, observe the stock's price movement. Draw a line at the high and low of that price range. This is your opening range. 2. Watch for the breakout. After the opening range is established, the next step is to watch for a breakout. If the price breaks above the high of the range, that's a bullish breakout, signaling that the stock could keep moving up. If the price breaks below the low, that's a bearish breakout, suggesting that the stock could drop further. The breakout should ideally happen with strong volume. A higher volume suggests that the breakout has real momentum behind it. 3. Enter the trade. Once the breakout happens, you enter the trade. For a bullish breakout, you'll want to buy as the price moves above the high of the opening range. For a bearish breakout, you'll short the stock as it drops below the low of the range. The key here is to act quickly after the breakout to capture the early momentum. 4. Set stop loss and targets. Use a stop loss just outside the opening range. If the price breaks back into the range, you'll want to exit the trade to prevent big losses. Set a target price based on previous support and resistance levels, or use a risk-to-reward ratio to determine how far you expect the price to move. Why opening range breakouts work? The opening range breakout strategy works because in the early moments of market open, stocks often experience sharp price movements. These initial moves are typically fueled by news, earnings reports, or market sentiment, and they provide clues about how the stock is likely to behave for the rest of the day. Steps to trade opening range breakouts. 1. Wait for the first few minutes after the open. Don't rush in too soon. You want to see where the price is heading. 2. Identify the high and low of the stock's price movement during the first 5 to 15 minutes. This is your range. 3. Watch for a breakout above the high or below the low. 4. Enter the trade as soon as the breakout happens and make sure to confirm it with volume. 5. Set a stop loss just outside the range to manage risk and target a profit at key price levels. Things to watch out for. 1. False breakouts. Not every breakout will lead to a big move. Sometimes the price breaks out, only to quickly reverse and move back into the range. This is called a false breakout. To minimize this, make sure the breakout is supported by volume and that the overall market sentiment is aligned with the breakout direction. 2. Waiting for confirmation. Some traders wait for a confirmation before entering the trade. For example, they might wait for the stock to break a certain price level and then pull back slightly before continuing in the breakout direction. 3. Use a smaller time frame for entry. After the breakout happens, some traders wait for a small pullback or consolidation on a lower time frame, like 1 minute or 3 minute charts, to enter at a better price. When to use opening range breakout. High volatility markets. Opening range breakouts work best when the market is active and volatile. Look for stocks with increased volume in the morning, as this shows there is more market activity. Trending markets. This strategy works well when the market is in a strong trend, either up because the breakout direction tends to follow through. After earnings reports or major news. Stocks that gap up or down due to news can often produce a strong opening range and create a solid breakout opportunity. Tips for success. 1. Focus on liquid stocks. Stocks with high volume are more likely to have clean breakouts. 2. Use a solid risk-to-reward ratio. Since this is a momentum strategy, aim for at least a 2:1 or 3:1 risk-to-reward ratio. 3. Trade with the trend. If the broader market is trending up, focus on bullish breakouts. If the market is trending down, focus on bearish breakouts. 4. Don't chase the price. If you miss the breakout, don't force the trade. There will always be other opportunities. Final thoughts. Opening range breakouts are a great way to catch early momentum in the market. By identifying the initial price range after the market opens and then trading the breakout, you're positioning yourself to capture big moves right from the start of the trading day. But, like with any strategy, make sure you're managing your risk and waiting for the right signals. Develop your own strategy. Now, let's get to something really exciting, creating your own strategy. While it's great to learn from others, one of the best things you can do as a trader is to develop a strategy that works for you. Here's how you can go about it. 1. Understand your goals. What's your goal with trading? Do you want to trade actively throughout the day, or are you more of a long-term trader? Are you in it for quick profits or steady, reliable growth? Once you know your goals, it's easier to tailor your strategy around them. 2. Pick your tools. Think about what indicators or tools you're going to use. Some traders prefer using moving averages, others like Bollinger Bands, or maybe you prefer trading based on support and resistance levels. The tools you pick should align with your trading style. 3. Test and refine. Don't just pick a strategy and go full throttle right away. Backtest your strategy using historical data to see how it would have performed in the past. This will give you confidence in your strategy's reliability. Keep refining it, adjusting your approach based on what works and what doesn't. 4. Start small. When you're testing your own strategy, always start with small position sizes. This minimizes your risk while you're still learning how to perfect your plan. Remember, it's better to be cautious than to dive in too deep too quickly. 5. Be consistent. The key to success is consistency. Stick to your strategy and avoid chasing the hot trade of the moment. If your strategy tells you to wait for a certain setup, wait. Consistent, disciplined trading is what leads to long-term success. Trading based on the time of day. When it comes to day trading, the time of day you trade can actually make a big difference. The market behaves differently at different times, so let's look at how you can adapt your strategy based on when you're trading. 1. The market open, 9:30 a.m. to 11 a.m. ET. This is when the market is usually the most volatile. Prices can swing wildly in the first 30 minutes to an hour. A lot of day traders take advantage of these wild moves by jumping into breakouts or momentum trades. If you're trading during this time, you'll want to be quick and ready to make fast decisions. 2. Midday, 11 a.m. to 1 p.m. ET. During this period, the market tends to calm down a bit. price action becomes less volatile and many traders take a break. It's not unusual for the market to enter a phase of consolidation where prices move sideways. If you're trading during this time, you'll want to look for opportunities where the stock has found support or resistance and is ready to break out of that range. 3. The afternoon session, 1 p.m. to 4 p.m. ET. In the afternoon, the market can get another burst of activity, especially as we get closer to the closing bell. Some traders focus on final trades before the market closes, looking for closing range breakouts or taking positions on stocks that are showing strong momentum into the close. This can be a good time to ride out trends if you've caught one earlier in the day. 4. After hours, 4 p.m. ET and beyond. After the market officially closes, you might think the action is over, but after hours trading still happens. It's more low volume, and prices can move based on news, earnings reports, or other major events. After-hours trading isn't for everyone, but if you can handle the lower liquidity and higher spreads, you can potentially catch big moves. Final thoughts. To sum it up, trading isn't just about following one strategy. It's about adapting and being flexible. Whether you're using scalping, momentum trading, or creating your own strategy, you'll find that trading is more than just a set of rules. It's a process of learning, adjusting, and mastering the market's rhythm. And remember, the time of day can change the game. So, whether you're taking advantage of the market opens volatility, riding trends in the afternoon, or creating your own personal strategy, always make sure to manage your risk and stay disciplined. All right, let's dive into Chapter 8, Step by Step to a Successful Trade, where we're talking all about building a watch list, a key component of your trading journey. If you want to stay ahead of the game, this part is crucial, so stick around. Building a watch list, selecting stocks to monitor. A watch list is basically a list of stocks you're monitoring closely, but it's way more than just scribbling down some names. It's a tool to help you find profitable opportunities and track potential trades. If you're serious about day trading, having a watch list is essential. Why you need a watch list. So why should you even bother with a watch list? Here's the thing. The stock market is huge, with thousands of stocks to choose from. You can't just pick a random stock and hope it works out. A good watch list helps you filter out noise and focus on stocks that have the highest potential for making moves. Your watch list gives you a focused group of stocks that are showing signs of volatility, which means they're likely to make big moves, just the kind of stocks you want to trade. This helps you stay organized and save time. Instead of sifting through hundreds of stocks each day, you only look at the ones that fit your criteria. How to build your watch list. Now, let's break down the steps to building a solid watch list. 1. Look for high volume. Volume is a key factor when choosing stocks for your watch list. High volume stocks are more liquid, meaning they're easier to trade in and out of without big price shifts. You want stocks with at least a few 100,000 shares traded daily. This ensures there's enough action to profit from. 2. Check for volatility. If a stock's price isn't moving much, there's not much for you to profit from. Look for stocks that are showing some consistent price movement. These could be stocks that are moving up or down in the short term, or stocks that are seeing major price fluctuations. Volatility is key because it gives you room to make profits. 3. Use pre-market and after-hours data. It's not just about the regular trading hours. You want to look at pre-market and after-hours trading too. These can give you early indications of how a stock might move when the regular session starts. For example, if a stock is showing strong movement before the market opens, it could mean a big breakout is on the way. 4. Identify news catalysts. A great stock for your watch list often has some sort of news catalyst. This could be earnings reports, FDA approvals, or anything that could make the stock's price move in a significant way. Keep an eye on news and announcements. Stocks reacting to news are often much easier to trade. Number 5. Pick stocks with liquid options, if trading options. If you're trading options, you'll want to add stocks that have liquid options. These are stocks with options that have plenty of open contracts, so you can easily buy and sell without slippage. Stocks with good options liquidity are generally large, well-known companies with tons of volume. 6. Stick to a set number of stocks. It's tempting to add every stock that shows potential, but that can overwhelm you. Try to limit your watch list to about 5 to 10 stocks. This allows you to really focus and get to know the behavior of those stocks. You'll become more familiar with their movement, making it easier to spot good opportunities. Updating your watch list regularly. Building your watch list is just the start. You need to update it regularly. The stock market isn't static. Stocks can quickly lose or gain volatility, change trend directions, or react to new news. You don't want to waste time tracking stocks that aren't performing well. On the other hand, you also want to add stocks that are showing new signs of opportunity. So, make sure to check in daily and adjust your list accordingly. Key tips for maintaining a strong watch list. 1. Be selective. Don't feel the need to track every stock that catches your eye. Be selective and focus on those that are showing the right kind of movement and volatility. 2. Look for patterns. Over time, try to identify recurring patterns with the stocks on your watch list. Some might have predictable reactions to news, while others might follow certain technical patterns. This helps you develop an edge. Number 3, use scanners to filter stocks. Scanners are a great tool to quickly find stocks that meet your criteria. Set up scans based on volume, price movement, and other indicators to find stocks that meet your trading style. Conclusion. To wrap things up, your watch list is like your personal hunting ground for great trading opportunities. By selecting stocks based on volume, volatility, and news catalysts, you can focus your attention on the best potential trades. Remember, quality over quantity is key. Stay disciplined, update your list regularly, and keep honing your strategy. All right, let's jump into another critical part of your trading journey, crafting a trading plan. This is your blueprint for each trade, and trust me, having a solid plan is key to your success as a day trader. We'll break down how to create a well-thought-out strategy that covers entry, exit, and stop loss. Stick around. It's time to take your trading to the next level. Trading plan, entry, exit, and stop loss. A trading plan is not just a set of rules. It's your roadmap to success. Every trade you make should be pre-planned, and this is where entry, exit, and stop loss come into play. 1. Entry. Timing your entry right. Your entry point is the exact moment you decide to open a position. This is one of the most critical parts of your trade because it sets the stage for everything that follows. Getting the entry right is key to making a profitable trade. Look for clear setups. Before you make an entry, ensure you have a clear reason for entering the trade. This could be a technical signal, like a breakout or bounce off support, or a news catalyst driving the stock. Confirm the trend. Don't rush in. Check if the market is trending up or down and enter with the trend. Trading against the trend increases your risk. You want to buy in an uptrend or sell in a downtrend. Wait for the right signal. Don't enter on impulse. Use indicators, patterns, or chart signals to confirm your entry. For example, you might want to enter after a bullish candlestick pattern or when a stock breaks a certain price level. The key takeaway here? Patience is crucial. You don't want to jump in too early and risk losing your edge. Let the market come to you. 2. Exit, knowing when to take profit. Once you're in a trade, the next step is to plan your exit. Knowing when to cash out and take your profits is just as important as knowing when to enter. Set profit targets. Before entering a trade, decide at what price you'll exit. This could be based on technical levels, like resistance for a long position or support for a short. Setting a profit target helps you avoid getting greedy and ensures you're locked in when you hit your goal. Use trailing stops. If the stock is moving in your favor, consider using a trailing stop to lock in profits while still allowing the stock to move further. This allows you to ride the trend and capture more gains if the stock keeps going up. Have an exit strategy. Sometimes a trade doesn't go as planned, and that's okay. The key is having a pre-planned exit strategy. Know what your target profit is and stick to it. Planning your exit is all about being prepared to take profits and not getting emotionally attached to a position. 3. Stop loss. Limiting your losses. The most important part of your trading plan is risk management. The stop loss is your safety net. It helps you limit potential losses and protect your capital. Set a fixed stop loss. Before entering a trade, decide where your stop loss will be. This could be based on a percentage loss from your entry point or below a key support level if you're going long. Typically, traders risk about 1 to 2% of their capital per trade. Use mental stops. If you're experienced, you might use a mental stop, meaning you're committed to exiting at a certain price but won't place the order. However, this is riskier because emotions can interfere. It's always better to have a physical stop loss order in place. Don't move the stop loss to stay in the trade. One common mistake is to move the stop loss further away when the trade is losing. Don't do it. This just increases your risk and can lead to bigger losses. Stick to your plan and exit when your stop loss is hit. The goal of a stop loss is to protect you from major losses and keep you from making impulsive decisions in the heat of the moment. Putting it all together, entry, exit, and stop loss in action. Let's put this all together in a simple example. Entry. You've analyzed a stock and decided to enter at $50 because it's breaking above a resistance level. Exit. You've set your profit target at $55 based on the next level of resistance. If the stock reaches $55, you'll exit for a profit. Stop loss. To limit risk, you place your stop loss at $48, ensuring you're only risking 2% of your capital if the stock goes against you. By having a clear entry point, a defined exit, and a set stop loss, you're taking emotion out of the trade and sticking to your strategy. Conclusion. Having a trading plan that includes your entry, exit, and stop loss is a game changer. It helps you stay disciplined, prevents emotional trading, and limits your risk. A well-thought-out plan is what separates successful traders from those who end up losing money. Remember, trading isn't about guessing or hoping. It's about planning and following through. Stick to your plan, and you'll increase your chances of success. Now let's talk about execution, the all-important moment when you finally put your trading plan into action. You've done all the hard work with your entry, exit, and stop loss. Now it's time to execute flawlessly. The way you implement your plan can be the difference between success and failure in trading. So let's dive into how to execute your plan effectively. Execution, implementing the trading plan effectively. Executing a trade isn't just about clicking a button. It's about staying disciplined, avoiding impulsive moves, and following through with your pre-planned strategy. Here's how to make sure your execution is on point. Act 1. Stick to your plan. First things first, do not deviate from your plan. You've already decided on the entry point, the exit, and the stop loss. Now it's time to trust your plan and execute it without hesitation. Resist emotional decisions. It's easy to feel tempted to change things as the market moves, but remember, emotions are your worst enemy when trading. Stick to what you've planned. Avoid chasing the market. Sometimes, the market can move fast and you might feel the urge to chase the trade. But don't get greedy. If the stock moves past your planned entry, let it go. There will always be another opportunity. Trust your strategy. You've already done the hard part by planning the trade. Now, stick to your strategy and let the market come to you. If the stock reaches your entry point, execute. If not, move on to the next opportunity. Hanrasha 2. Use limit and stop orders. Limit orders and stop orders are your best friends when it comes to executing trades. Limit orders. These are great when you want to buy or sell at a specific price or better. It ensures you're not entering a trade at an unfavorable price. For example, if you want to buy a stock at $50, but the stock is currently at $51, you can set a limit order at $50. You won't get in unless it drops to that price. Stop orders. These are perfect for protecting your trade. A stop order turns into a market order when a stock hits a certain price, ensuring you get out of the trade and cut your losses if the market moves against you. For example, if the stock is moving in your favor and hits your profit target, a stop order will lock in profits without you having to monitor every move. Using these orders ensures you're executing efficiently without constantly watching the market. The market doesn't wait, and automated orders help you execute quickly and correctly.
3. Monitor the trade.
But don't overanalyze. Once the trade is in motion, don't obsess over it. Check in periodically, but don't let the trade consume you. Here's how to stay balanced. Track the trade. You should always know where the stock is relative to your entry, exit, and stop loss. Keep an eye on the key levels that could trigger your plan. Don't overanalyze. It's easy to get caught up in the tiny fluctuations of the market. But remember, you've already planned your trade. Trust the process and don't overthink it. Adapt to market movements. If the market shows signs of a reversal or something unexpected happens, you may need to adjust. But these adjustments should be pre-planned, like setting trailing stops and not made on a whim. 4. Be prepared for slippage and market variability. One reality of trading is that prices don't always match the levels you expect. This is known as slippage. It happens when there's a gap between your expected entry or exit price and the actual price at which the trade is executed. Slippage happens. Don't get frustrated if the price isn't exactly where you planned. It's part of trading. The key is to have a range for your target and stop loss, and to allow for some flexibility in your plan. Plan for volatility. Sometimes the market will be extra volatile and the price will bounce around. That's okay. The important thing is to keep your cool and trust the strategy you've already created. 5. Reviewing and improving. Execution isn't just about doing things right the first time. It's about improvement over time. Review your trades. After each trade, take some time to review what went well and what didn't. Did your entry and exit match your plan? Were your stop losses in the right place? This process helps you refine your strategy and improve your execution. Learn from mistakes. Everyone makes mistakes, but the key is to learn from them. If your execution didn't go as planned, figure out what went wrong and how to adjust next time. All right, let's talk about evaluating your trade performance. This is an absolutely crucial part of your trading journey. You might think that once the trade is done, it's over, but the real growth happens when you take a step back and ask yourself, how did I do them? How did I do them? Evaluating trade performance. Evaluating your performance after a trade is the key to improving and refining your skills. Here's how you can look at your trades to see where you're winning and, more importantly, where you're losing. This is where the real magic happens, so listen up. 1. Review every single trade. It's easy to look at your winners and feel proud, but you need to review every single trade, whether it's a win or a loss. Here's why. Winners are easy. When you win, it feels great, and you might think everything went perfectly. But did you really follow your plan? Did you stick to your entry and exit points, or did you get lucky? Losses are lessons. Losing feels terrible, but every loss is a lesson. Did you follow your stop loss? Did you get emotional and make impulsive decisions? Understanding why you lost is the key to making sure it doesn't happen again. Look at the process, not just the outcome. This is a huge point. When reviewing your trades, focus more on the process rather than just the result. Did you stick to the plan? When evaluating, ask yourself, did I follow my entry, exit, and stop loss levels? If you deviated, why did that happen? Was it emotions? Or did the market change unexpectedly? Was the timing right? Did you execute at the right time? Timing is everything. If you entered a trade too early or too late, ask yourself why that happened. Were you in a rush or not paying attention? Risk management. Did you manage risk correctly? Were you risking too much of your capital on one trade? Were your stop losses properly set to protect you from big losses? Path 3, record keeping is key. You need to have a solid trading journal. This isn't just for fun, it's for improvement. Write down every trade you make. What was the trade setup? Note down the chart patterns, the stock's movement, and your reason for taking the trade. What was the outcome? Whether you won or lost, write down the result, including the exact price points at entry, exit, and stop loss. Emotional check. This is a game changer. Write down how you felt during the trade. Were you anxious, excited, or calm? Emotional decisions can heavily influence your results, so tracking your mood can reveal patterns. 4. Review your win rate and risk to reward ratio. 2 things you really need to analyze. Win rate. This is the percentage of profitable trades out of the total trades you've made. For example, if you made 100 trades and 60 were profitable, your win rate is 60%. Keep track of this regularly to see if there's any improvement. Risk to reward ratio. This is how much risk you took versus how much reward you aimed for. For example, if you risked $1 to make $2, your risk to reward ratio is 1:2. Analyzing this will help you see if your risk management is in line with your reward expectations. If you're risking too much for too little reward, you'll quickly burn through your account. 5. Ask the tough questions. After every trade, ask yourself these hard questions. Did I follow my plan, or was I just reacting to the market? Was I too eager to trade, even when the setup wasn't perfect? Did I allow my emotions to control the trade? Was I greedy or fearful? What could I have done differently? Could I have been more patient or more disciplined? These questions help you pinpoint where you went wrong and where you did well. 6. Track your progress over time. You don't just want to look at individual trades. Track your performance over time to see how you're improving. Look for patterns in your mistakes. Maybe you're consistently making the same mistakes, like entering too early or not cutting losses fast enough. Identifying these trends helps you address the root cause. Celebrate your small victories. If you're seeing improvement in your win rate, or if you're sticking to your plan more often, give yourself credit. Progress is progress, no matter how small. Keep learning and evolving. Evaluating your trades isn't a one-time thing. You should continuously evolve. Keep learning from your past mistakes and successes, and make adjustments to your strategy accordingly. The more you evaluate, the more you'll fine-tune your trading strategy for success. Conclusion. Evaluating your trades is where the real work begins. It's not about just looking at your profits and losses. It's about understanding the process behind each trade and finding areas where you can improve. By keeping a trading journal, analyzing your win rate and risk-to-reward ratio, and asking the tough questions, you'll continuously refine your skills and become a better trader. All right, let's dive into Chapter 9, Case Study of a Newly Successful Trader. This chapter is all about a beginner's journey to success in the world of day trading. And trust me, there's so much we can learn from it. So let's break it down and see what this new trader's experience can teach us. Insight from a newly successful trader. The journey of becoming a successful trader is never easy. It's filled with ups and downs, moments of doubt, and breakthroughs that can change everything. But one thing is for sure, there's always something to learn from each step along the way. 1. Starting with the basics. This new trader's journey starts just like yours probably did, with nothing but curiosity and a burning desire to succeed. But here's the key. They didn't dive in blindfolded. They began by understanding the basics of trading, including things like market mechanics, how the stock market works, what drives price movements, and how to read charts. Risk management, how to protect your capital and never risk more than you can afford to lose on any single trade. Trading psychology, the mental game behind trading, staying calm, focused, and disciplined. They made sure they understood the foundations before jumping in with real money, and this is something every new trader should do. 2. The first steps, trial and error. At the beginning, things weren't perfect. In fact, this trader made a lot of mistakes. Losses piled up and mistakes were made. They chased after hot tips from others, ignored their strategy, and didn't always stick to their plan. Sound familiar? But here's the thing. They didn't quit. They treated every loss as a lesson and kept improving. The key takeaway here is that failure isn't the end. It's part of the process. Every trader, no matter how successful, has gone through their share of mistakes. 3. The turning point, building confidence and consistency. After a series of losses and lessons, the trader finally started to see the light. They realized that success doesn't come from random guesswork or simply following the crowd. Instead, it comes from a solid plan. They created a trading strategy that worked for them based on their strengths and weaknesses. Patience. They learned to wait for the perfect trade setup rather than jumping into anything that moved. Consistency. By sticking to their strategy, staying disciplined, and not chasing after every opportunity, they started seeing more consistent results. That's when the trader began to build confidence. They understood that trading wasn't about making quick profits, but about making the right decisions over and over again. Learning from mistakes, the power of reflection. One of the most important parts of this trader's success was the ability to reflect. After each trade, win or lose, they would review their trades. Did they follow their plan? Did they get emotional? Did they make any mistakes? Track their progress. They kept a journal of every trade so they could see patterns, both good and bad, in their decision-making. This constant reflection allowed them to fine-tune their approach, improve their discipline, and adapt to the markets as they changed. 5. Realizing the importance of risk management. At one point, the trader had a breakthrough moment. They realized that protecting their capital was even more important than making profits. They started to implement strict risk management rules, like only risking a small percentage of their capital on each trade, usually around 1 to 2% per trade, setting stop losses to automatically close a trade if it went against them, using position sizing to ensure they weren't overexposed to any single trade. By sticking to these risk management rules, they minimized their losses and were able to survive through periods of market volatility. 6. Becoming a consistent trader. Now, after many trials, this trader started making steady profits. They became consistent, not by winning every single trade, but by executing their strategy reliably and professionally. Consistency comes from mastering the basics, always using a proven strategy, emotionally detaching, not letting greed or fear affect your decisions, accepting losses as part of the game. Instead of letting them derail their confidence, they saw each loss as a learning opportunity. Top 7. Key takeaways from their journey. Here's what we can learn from this newly successful trader. 1. Don't rush the process. Success takes time. Focus on learning and improving rather than getting rich overnight. 2. Accept losses. They are part of the journey. Learn from them and move on. 3. Consistency is key. Stick to your plan and trade with discipline. 4. Risk management is everything. Protect your capital and never risk too much on any one trade. 5. Reflect and adjust. After every trade, review and tweak your strategy based on your performance. Conclusion. Your path to success. This trader's story is a reminder that everyone starts somewhere. It's not about how quickly you succeed. It's about how you learn from your failures and how you improve each day. By focusing on consistency, risk management, and self-reflection, you can transform from a beginner to a consistently profitable trader, just like this case study. So, take these lessons, apply them to your own trading, and remember, success is a journey, not a destination. All right, let's dive into a crucial part of Chapter 9 from How to Day Trade for a Living, the early stages of becoming a trader. This section is all about laying the foundation for success and learning from the early challenges that come with day trading. So, let's get started. Early trading education. Building the foundation. Before jumping into the fast-paced world of day trading, the first and most important step is getting solid foundational knowledge. Think of it like learning how to ride a bike. You need to understand the mechanics first before trying to take off at full speed. Foundational knowledge includes things like market basics, understanding how the stock market works, what drives prices, and what causes fluctuations. This is where you get familiar with concepts like supply and demand, market orders, and stock exchanges. Technical analysis, learning how to read charts, identify patterns, and understand indicators. This is your tool set for making informed decisions during the trading day. Risk management, the most crucial part. You need to understand how to protect your capital by setting stop losses, limiting your exposure, and not risking more than you can afford to lose on any trade. Trading psychology, the mental game. Trading isn't just about numbers and charts. It's about controlling your emotions, like fear, greed, and frustration. This is what separates the successful traders from the ones who burn out. This education is a mix of studying and practicing. While books, courses, and tutorials are essential, the most valuable knowledge comes from hands-on experience and learning from your mistakes. Beginning to day trade, first steps and early lessons. Now that you have your foundational knowledge, it's time to begin day trading. But don't expect everything to be smooth sailing from the get-go. This phase is all about learning by doing. And yes, that often means making mistakes. When you start, it's common to feel overwhelmed by the sheer amount of information. There are so many things to keep track of, from market movements to news events to managing multiple trades at once. It's easy to get lost in the noise. But here's where the first lessons come in. 1. The importance of starting small. One of the most valuable lessons from the beginning of this trader's journey was starting small. Don't jump in with big money right away. Start with a small account size and focus on getting comfortable with the process. This allows you to make mistakes without losing too much capital. Think of it like training wheels on a bike. You need that time to get used to how everything works before you go full throttle. 2. Realizing the power of risk management. In the early days, this trader experienced the pain of losing more than expected. At first, it felt like they were taking 2 steps forward and 1 step back. But the key lesson here was realizing how important risk management is. When you're new to trading, you might feel the urge to go big, take risks, and chase profits. But what really matters is protecting your capital. They quickly learn to set realistic stop losses, calculate position sizes, and never risk too much on a single trade. This is the first step to building a sustainable trading career. 3. Understanding market behavior. The early lessons also involved learning how the market behaves. At first, the trader didn't fully grasp how important timing was. They'd often jump into trades too early or too late, missing out on the best entry points. Over time, they learned to watch the market closely, identifying key moments when a trade was more likely to succeed. This part is all about observing patterns, understanding market psychology, and being patient. You don't want to chase trades. You want to wait for the right setup. 4. Psychological challenges. Overcoming the emotional roller coaster. As you start trading, your emotions will go through a roller coaster. You'll experience excitement during wins, frustration during losses, and fear of losing your capital. These emotional ups and downs can cloud your judgment and lead to impulsive decisions. For this trader, the key to survival in the early stages was learning to manage their emotions. They focused on staying calm and disciplined regardless of the market's volatility. When a trade didn't go their way, they learned to accept the loss and move on. When things were going well, they didn't let greed take over. 5. Continuous learning and adapting. No matter how many books you read or courses you take, nothing compares to the knowledge gained from experience. This trader quickly learned that the markets are always changing, and no single approach works forever. Adaptation was key. They became open to new strategies, updated their trading plans, and kept refining their methods. Each day brought new lessons, and with each mistake, they gained a bit more wisdom. The goal wasn't to be perfect right away. It was to keep improving with each trade. Key takeaways. Here's what we can learn from this stage in the trader's journey. 1. Get the basics right. Understand the markets, risk management, and psychology before jumping into trading. 2. Start small. Don't risk too much early on. Begin with small trades to build experience. 3. Focus on risk management. Protect your capital and always have a stop loss in place. 4. Learn market behavior. Study patterns, understand the market's psychology, and wait for ideal entry points. 5. Manage emotions. Keep your emotions in check. Don't let fear, greed, or frustration drive your decisions. 6. Keep learning. Trading is an evolving skill. Always be open to learning and adapting. By starting with these core principles and continuing to learn from every experience, you'll be able to navigate the early challenges of day trading and build a strong foundation for long-term success. Hitting my low point, overcoming challenges and failures. In every trader's journey, there comes a moment where you feel like you've hit your lowest point. Maybe you've taken a series of losses, or maybe the emotional weight of the market's unpredictability is just too much to bear. Whatever the case, it feels like you're stuck in a hole with no way out. But here's the key lesson. Failure is part of the process. No one gets to the top without facing tough times. For this trader, the low point wasn't just about losing money, it was about losing confidence. When you've poured your energy and effort into something and the results aren't reflecting your hard work, it's easy to start questioning your abilities. But here's where the real lesson comes in. You can't let that failure define you. What they did to overcome the low point. Reevaluated the approach. First, the trader took a step back and analyzed what went wrong. Instead of blaming themselves, they looked at their trading plan, their strategy, and their risk management techniques. What did they need to change? Emotional reset. This was a major emotional roller coaster. The trader realized that emotions were affecting their decisions. Fear and frustration were clouding their judgment. To overcome this, they took a break, cleared their mind, and reconnected with their passion for trading. Focused on small wins. One of the best ways to get out of a slump is to focus on smaller, achievable goals. The trader stopped aiming for big profits and instead focused on making small, consistent trades with clear, manageable goals. This helped rebuild confidence and reminded them that progress isn't always linear. Learned from mistakes. Instead of dwelling on the failures, the trader started viewing each loss as a lesson. They didn't see failure as defeat, but as a valuable part of the learning curve. This mindset shift made all the difference. Risk the same amount of money per trade. Consistency in risk management. One of the critical mistakes that can happen when you're struggling is inconsistent risk management. When things aren't going well, it's easy to start chasing bigger profits to recover losses. But that's a dangerous game that can lead to even more trouble. This trader learned that the key to success lies in consistency, and that starts with risk management. Here's the key takeaway from this part. Risk the same amount on each trade. The trader's low point came when they started risking varying amounts per trade. One day they risked more to make up for a loss. The next day they played it safe. This inconsistency made things worse. But the moment they decided to risk the same fixed amount on each trade, they found balance. By sticking to a specific percentage of their total capital, they minimized the emotional roller coaster and brought back stability to their trading strategy. Control over emotions. By risking the same amount on every trade, they stopped getting emotionally attached to each win or loss. The fear of losing everything on one bad trade disappeared. They no longer saw each trade as a make or break moment, but as part of a consistent process. Building trust in the system. This trader realized that consistency builds trust in their strategy and process. The key was not chasing huge profits, but focusing on steady, sustainable gains over time. Even though each trade might feel small, over time, these small steps add up to significant success. Key takeaways. Here's a recap of the essential lessons from this stage in the trader's journey. 1. Failure is temporary. Don't let a setback define your path. Analyze, adapt, and come back stronger. 2. Emotional reset. Take a step back when things aren't working. Regain your mental focus before jumping back in. 3. Small wins matter. Focus on achieving small, consistent gains rather than trying to recover big losses. 4. Risk consistently. Always risk the same amount of money per trade. This keeps your emotions in check and ensures long-term consistency. 5. Learning from mistakes. View losses as lessons. Every failure is a stepping stone to success. Remember, every trader goes through ups and downs, but it's how you respond that defines your success. Don't fear failure, because it's a part of the journey. Keep your emotions in check, stay consistent, and above all, trust in your process. Let's dive into 2 critical concepts for any trader: risking a small amount of money per trade until you are consistent, and using hard stops to exit trades. These are game changers for anyone looking to grow steadily as a trader. Let's break them down. Risk a small amount of money per trade until you are consistent. When you're starting out in day trading, it's tempting to dive in with big trades, aiming for big profits. But here's the thing. Success in day trading isn't about how much you make on each trade. It's about how consistently you can win over time. That's why the best approach is to risk a small amount of money per trade at the beginning. Why? Because you need to focus on developing consistency, not making quick profits. Why start small? Minimize losses. When you're learning the ropes, you're bound to make mistakes. The idea of risking a small amount is to minimize the damage while you're still in the learning phase. It's like walking before you run. Build confidence. Smaller trades mean less stress. As you start seeing consistent small wins, your confidence will build. You're creating a solid foundation to scale up later on. Master your strategy. This approach lets you focus on refining your trading strategy without the emotional baggage that comes with large losses. You get to experiment, learn, and adjust without risking too much. What happens when you're consistent? Once you've got a steady track record of small wins and have mastered your system, then you can start gradually scaling up your trading size. The key here is that consistency and risk management should always be the focus, not rushing for bigger profits. Use hard stops to exit trades. Next up, using hard stops to protect yourself when trades go south. If you're not using stop-loss orders, you're opening yourself up to unnecessary risk. What is a hard stop? A hard stop is simply a preset price level where you decide to exit the trade if things aren't going your way. For example, if you're trading a stock and you're willing to risk losing stock to 2% of your capital on that trade, you set your stop loss at that level. Why use hard stops? 1. Prevents emotional decisions. When the market moves against you, emotions can take over. You might think, I'll hold on a bit longer, it will bounce back, but this kind of thinking can quickly lead to bigger losses. With a hard stop, you take the emotion out of the equation and stick to your plan. 2. Limits your losses. A stop loss ensures that you never lose more than what you're willing to risk. Instead of looking at a huge red loss, you simply exit at a predetermined price, keeping your losses controlled and your account safe. 3. Discipline in trading. Setting a hard stop helps you stick to your trading rules. You've already decided your risk tolerance, and the stop loss keeps you accountable. It forces you to follow your plan, a critical trait for long-term success in day trading. How to use hard stops effectively. Place stops as soon as you enter a trade. As soon as you make your buy or sell decision, set your stop loss. This ensures that you've locked in your risk before emotions can cloud your judgment. Adjust stops based on market conditions. If the market is trending in your favor, you can trail your stop, adjust it upwards or downwards to lock in profits while giving the trade room to grow. Key takeaways. 1. Risk small at first. Start by risking a small amount of money per trade. Focus on building consistency and mastering your strategy. Gradually scale up once you're consistent. 2. Hard stops are non-negotiable. Use hard stops to exit trades that aren't working out. This removes emotions, limits your losses, and helps you stick to your trading plan. 3. Consistency over size. The goal isn't to make big profits right away. It's to consistently make small, smart decisions that add up over time. By implementing these two strategies, small risk per trade and hard stops, you're setting yourself up for long-term success in day trading. Focus on consistency, manage your risk, and let the profits follow. Focus on a single strategy until you master it. When you're starting out in day trading, it's easy to get caught up in the shiny object syndrome. You see a new strategy and you want to try it. You jump from one strategy to another. But here's the thing. Focus on mastering just one strategy first before you think about trying others. Why focus on just one strategy? Simplicity leads to mastery. If you try to learn everything at once, you're spreading yourself too thin. But when you stick to one strategy, you can dive deep into it, understand it inside out, and perfect it. You get to know the ins and outs of how that strategy works, when it's most effective, and how to tweak it to suit your trading style. Avoid overwhelm. There are so many strategies out there: scalping, momentum trading, reversal strategies, and so on. If you try to learn them all at once, you'll quickly become overwhelmed. Instead, pick one and really focus on mastering that one technique. Build confidence. The more you trade using the same strategy, the more confident you'll become. You'll learn what works, what doesn't, and you'll begin to see the results of your efforts. Confidence is key in day trading, and mastering one strategy is the first step toward achieving that. How to make this work? Pick a strategy that suits you. Choose a strategy that matches your personality and trading goals. If you're someone who likes fast action, you might go for momentum trading. If you prefer to trade around key levels, try support and resistance trading. Stick with it. Once you've chosen your strategy, commit to it. Avoid distractions from all the other strategies out there. Focus solely on getting better at your chosen approach. Once you've mastered one strategy and feel confident with it, then, and only then, you can start diversifying into other strategies. But first, build that strong foundation. Listen to experienced traders. Now, here's something that can fast-track your growth: listening to experienced traders. This doesn't mean just watching random YouTube videos or reading a few books. It means gaining insights from traders who have been in the game for years. Why should you listen to experienced traders? Learn from their mistakes. Experienced traders have already been through the ups and downs of the market. They've made mistakes, and they've learned from them. By listening to them, you can avoid making the same mistakes yourself. Understand the bigger picture. Sometimes, when you're starting out, it's easy to get bogged down in the details. Experienced traders can help you see the bigger picture. They'll show you how to think long-term and help you develop a clearer perspective on your trading. Get practical advice. While theoretical knowledge is important, real-world advice from experienced traders is what will truly help you level up. They'll teach you how to deal with emotional challenges, manage risk effectively, and develop a solid trading plan. How to listen to them? Join trading communities. You can find trading communities online where experienced traders share their strategies, tips, and insights. The power of community is incredible, and you'll learn faster when you have seasoned traders guiding you. Mentorship. If you can, find a mentor, someone who's been trading for years and can teach you the ropes. This kind of one-on-one mentorship can save you countless hours of trial and error. Follow reputable sources. Watch videos, listen to podcasts, and read books from traders who have been successful for a long time. Look for traders with a proven track record, not just someone promoting the next big thing. Key takeaways. 1. Focus on one strategy. Stick to one strategy and master it before moving on to others. This helps you avoid overwhelm, build confidence, and truly understand how that strategy works. 2. Learn from experienced traders. Gain wisdom from those who've already been through the grind. Learn from their mistakes, get practical advice, and tap into their real-world knowledge to level up your trading. 3. Don't rush to diversify. Mastery comes first. Once you're confident with one strategy and know it works for you, then and only then should you think about diversifying into other strategies. All right, let's wrap this up with a step-by-step examination of a successful trade, and then I'll give you the conclusion that ties everything together. We're diving into the nitty-gritty of what makes a trade successful and how you can apply these principles to your own trading journey. Step-by-step examination of a successful trade. So, you've made a trade, and it's gone well. But how do you know what made it work? What were the key components that led to success? Let's break it down step by step. Signal 1, planning the trade. Set your entry point. Before you even think about entering a trade, you need to know exactly where and when you're entering. Is it a breakout, a pullback, or a reversal? Planning your entry helps you avoid entering at the wrong moment due to FOMO, fear of missing out. Set your exit strategy. This is critical. You need to know where you're taking profits. Be realistic. Don't get greedy. If you're aiming for a certain percentage gain, stick to it. Set your stop loss before you enter the trade to minimize risk. 2. Managing risk. Position sizing. Never risk more than you can afford to lose. A good rule is to risk 1-2% of your account balance per trade. This keeps your account safe while giving you the chance to scale up as you become more profitable. Stop loss orders. Set a stop loss to automatically exit your position if the market moves against you. Don't wait until the loss becomes too big. You have to be disciplined about this. It's part of controlling your risk. Chapter 3. Execution. Enter the trade. Now that your plan is in place, it's time to execute. Whether you're using hotkeys or manually entering the trade, precision is key. Get in at the right price and don't hesitate. Monitor the trade. While your trade is running, you don't just sit back and relax. Keep an eye on the market and adjust your stop loss if needed. If the market moves in your favor, you can tighten up your stop or lock in profits. 4. Exit the trade. Profit target hit. When your target price is hit, exit with confidence. If you've set a clear target, don't second guess it. Take your profits and move on to the next trade. Stop loss hit. If the market goes against you, don't panic. Let the stop loss work for you. Exiting a losing trade is just as important as exiting a winning one. It's about preserving capital for the next opportunity. 5. Review and learn. Evaluate the trade. After the trade, take time to reflect. Did you stick to your plan? What went well, and what could you have done better? This is how you learn and improve. Each trade, whether profitable or not, is an opportunity for growth. Conclusion. Now that we've broken down the step-by-step process of a successful trade, let's put everything together. Key takeaways. 1. Planning is everything. Always have a clear entry and exit plan before you take a trade. 2. Risk management is crucial. Never risk too much on any single trade. Use stop losses and position sizing to protect your account. 3. Discipline is your best friend. Stick to your plan, even when emotions try to steer you off course. 4. Reflection and review are vital. Learn from every trade and use that knowledge to improve over time. In day trading, there's no magic formula, but with the right strategies, risk management, and continuous learning, you can make steady progress towards success. Focus on mastering the basics, and as you gain experience, you'll develop your own methods for finding high-probability trades. All right, let's dive into Chapter 10, where we talk about the 7 essentials for day trading. If you're just starting out or you're looking to sharpen your skills, these 7 principles are absolutely crucial for your trading journey. Let's break them down one by one. Develop a solid trading plan. You cannot just jump into day trading without a clear strategy. A trading plan is like your roadmap. It guides you through every decision you make. This plan should include entry points, exit points, stop loss levels, and profit targets. Having a plan in place ensures you're not making emotional decisions when the market moves unexpectedly. Remember, plan your trade and trade your plan. 2. Manage your risk. Risk management is the cornerstone of day trading. It's not about making massive profits on every trade. It's about protecting your capital so you can stay in the game long enough to have successful trades. Never risk more than 1-2% of your account on a single trade. Always use stop-loss orders to limit your losses and protect your downside. The goal is to preserve capital so you can trade another day. 3. Master the basics of technical analysis. You don't need to be an expert right away, but having a solid understanding of technical analysis is essential for day trading. This includes reading candlestick patterns, understanding support and resistance, and using indicators like moving averages or the RSI. Technical analysis will help you identify potential entry and exit points, giving you a higher probability of success. 4. Focus on a single strategy. When you're just starting out, it's easy to get caught up in trying every strategy under the sun, but this can overwhelm you. Instead, pick one strategy and focus on mastering it before moving on to others. Whether it's trend following, reversal trading, or breakout strategies, stick to one. Become an expert in that one strategy, and once you're consistently profitable, you can start exploring new methods. Keep a trading journal. A trading journal is an invaluable tool. It helps you track every trade, both the good and the bad. You can review your past trades to identify patterns in your decisions and learn from your mistakes. Record things like why you entered, why you exited, and what emotions were driving you during that trade. Over time, this journal will become a powerful tool for improvement. 6. Stay disciplined. Discipline is one of the most important traits of a successful trader. It means following your plan, not getting distracted by market noise, and avoiding emotional trading. Whether you're experiencing wins or losses, staying calm and sticking to your strategy will help you maintain consistency. Remember, the market will always be there, so don't rush into trades without proper preparation. 7. Learn from others. Don't be afraid to learn from experienced traders. Whether it's through online communities, mentorship, or reading books, there's a wealth of knowledge out there. Learn from others' successes, but also their mistakes. Network with like-minded traders, ask questions, and stay humble in your pursuit of knowledge. Everyone has been where you are at some point, and they've likely made mistakes you can learn from. Conclusion. So there you have it, the 7 essentials for day trading. To recap: 1. Develop a trading plan. 2. Manage your risk effectively. 3. Master the basics of technical analysis. 4. Focus on one strategy until you master it. 5. Keep a trading journal to track your progress. 6. Stay disciplined, no matter the market conditions. 7. Learn from others who are more experienced. If you follow these 7 principles, you'll be on the right path to becoming a successful day trader. It won't happen overnight, but with patience, practice, and the right mindset, you'll improve and eventually find your rhythm in the market. Don't be a gambler, be a trader. This is a crucial mindset shift that every new trader needs to make. A lot of beginners approach trading with a gambler's mentality. They're hoping for big wins without really thinking about risk or strategy. But let me tell you, trading is not a gamble. It's a business that requires discipline, preparation, and most importantly, a solid strategy. When you gamble, you're just hoping for the best, with no clear plan for the outcome. But when you trade, you're making calculated decisions based on technical analysis, risk management, and a well-thought-out trading plan. So, ditch the mindset of hitting a lucky streak and embrace the mentality of a professional trader. You need to develop a strategy, manage your risk, and stick to your plan. Every trade should have a purpose. You're not just shooting in the dark. Plan your trading business. Now let's talk about treating trading as a business. Yes, you heard that right. Trading is a business, and you need to treat it that way to succeed. A lot of people think that day trading is just about making quick profits, but successful traders know that it's about long-term consistency, managing losses, and continuously improving. When you approach trading as a business, you start thinking about it professionally. This means having clear goals, managing your capital, understanding the costs of trading, and being aware of the emotional challenges that come with it. Create a structured plan for your trading activities, just like any business. Set realistic goals, allocate a budget, and decide how much time you're going to dedicate to learning and trading. You wouldn't run a business without a plan, right? Similarly, you shouldn't trade without a clear strategy. Also, remember that emotional control is essential. The ups and downs of the market can be mentally exhausting, so treat your trading as a professional endeavor. Take care of your mental health and stick to your plan. Don't get distracted by the noise of the market. Conclusion. In short, don't gamble. Trade with a purpose. Treat your trading as a business and approach it with the same seriousness, discipline, and structure as any professional endeavor. It's not about luck. It's about consistent, informed decision-making. If you do that, you'll be well on your way to success. In this part of the book, we explore 2 very important concepts for every trader: journaling your trades and drawing parallels between trading and climbing. These are game-changing insights that can seriously boost your trading success. Let's dive in. Journaling your trades. First off, let's talk about journaling your trades. You might be thinking, why should I bother writing down my trades? Well, here's the deal. Keeping a trading journal is one of the most powerful tools for improvement. Imagine trying to get better at a sport without reviewing your performance. Wouldn't you agree it's much harder to improve without knowing what went wrong and what went right? A trading journal helps you track your successes, mistakes, and patterns. It allows you to see exactly why you made a certain trade, how you felt during it, and what the outcome was. More importantly, it helps you learn from your mistakes. Here's what you can track in your journal. Trade setup. Why did you enter the trade? What was your strategy? Entry and exit points. Where did you get in and where did you get out? Trade results. Did it go in your favor or against you? Emotional state. Were you feeling confident, anxious, or impatient? This is how you improve over time. When you go back and review your journal, you'll start noticing patterns in your decision-making and your emotions. You'll understand what works for you and what doesn't, and that's how you become a consistently profitable trader. Trading and climbing. Now let's talk about the parallels between trading and climbing. This might sound a little unexpected, but trust me, there are some amazing connections between these two activities. Imagine you're climbing a mountain. At first, it seems daunting. The peak looks so far away, and you might feel like you're never going to make it to the top. But as you climb, you take it one step at a time, carefully choosing your next move, analyzing your position, and adjusting when needed. Along the way, you might slip, lose your balance, or even fall back a little. But what do? You get back up and continue your climb, learning from each setback. This is exactly how day trading works. At first, it can feel overwhelming and the obstacles seem huge. But like climbing, the key to success is staying focused, learning from every trade, and never giving up. Just like a climber takes it one step at a time, you need to take one trade at a time, focusing on your process instead of worrying about the destination. You might experience setbacks, like a losing trade or a missed opportunity, but that's just part of the journey. The important thing is to keep going and stay disciplined. The more you climb, the better you get. And the same goes for trading. Every trade, every decision, whether successful or not, is a learning experience that will get you closer to the top. So remember, trading is a journey, not a sprint. If you approach it like a climber, focused on each step and learning from every experience, you'll eventually reach the top. Conclusion. In short, journaling your trades is the key to improving and making better decisions. It gives you a clear picture of your strengths and areas to improve. And when you combine that with the mindset of a climber, staying patient, disciplined, and focused on the process, you'll be well on your way to becoming a successful trader. We're going to dive into Andrew's 10 rules of day trading, the core principles that can transform your trading success. These are not just tips. These are essential rules you should live by if you want to make consistent profits in day trading. So let's get into it. Rule number 1, don't trade with emotions. Emotions can be a killer in day trading. Fear and greed can make you act impulsively, leading to poor decisions. Andrew's first rule is to stay calm and detached. Trading is all about logic, not emotion. If you're emotionally attached to a trade, you're more likely to overtrade or let your losses run. Discipline is key. Rule number 2, protect your capital. Your first job as a trader is to protect your capital. Don't risk it all on one trade. Even if you're confident, make sure you're only risking a small percentage of your total trading account. Protecting your capital ensures you're still in the game even after a loss. Think of your capital as your fuel. You need it to keep going. Rule number 3, use a stop loss. Never enter a trade without a stop loss. This is your safety net, the point where you automatically exit if the market moves against you. Andrew emphasizes that a stop loss helps to limit potential losses and protects your account from big swings. It's a must-have for anyone serious about day trading. Rule number 4, have a plan before you enter a trade. You can't just jump into a trade without a clear plan. Andrew's fourth rule is all about preparing before you hit the buy or sell button. Ask yourself, what's my entry point? Where's my exit point? What's my risk-reward ratio? A plan gives you structure and helps you avoid impulsive decisions. Rule number 5, don't chase the market. Don't chase price movements. This rule is about avoiding the FOMO, fear of missing out. If a stock suddenly spikes, don't panic and chase it. Andrew suggests waiting for a better entry point instead of jumping into a trade just because everyone else is doing it. This prevents you from buying into a false rally. Rule number 6, take your profits. Many traders get caught up in thinking the market will go even higher, but Andrew's 6th rule reminds us to take profits when you've reached your target. Don't get greedy. By taking profits regularly, you're locking in gains and ensuring that you stay ahead of the game. Rule number 7, trade what you know. Focus on markets you're familiar with. Andrew advises that you should master a few strategies and understand the stocks or assets you're trading. The more you understand the market, the better your chances of success. Don't try to trade everything. Specialize. Rule number 8, keep learning and improving. The market is constantly evolving, and so should you. Andrew's 8th rule is to always learn from your mistakes and keep improving. If you had a losing trade, take a step back and ask yourself, what can I do better next time? Continuous learning is one of the keys to staying profitable in the long run. Rule number 9, be patient. Patience is a trader's best friend. You don't need to trade every single day. Wait for the right opportunities, and don't force trades. Andrew stresses that sometimes doing nothing is the best decision. Waiting for the perfect setup can pay off more than forcing a trade that isn't there. Rule number 10, never stop practicing. Lastly, never stop practicing. The market changes, and so should your skills. Andrew reminds us that even the most successful traders are always practicing. Whether it's using a demo account, backtesting strategies, or reviewing your journal, constant practice ensures you're ready for whatever the market throws at you. Conclusion. So there you have it. Andrew's 10 rules for day trading success. Follow these guidelines, and you'll put yourself in the best position to succeed. Remember, discipline, planning, and continuous learning are the cornerstones of becoming a consistent trader. If you found this video helpful, don't forget to like, share, and subscribe to the channel. Also, hit that bell icon so you're always notified when we release more content to help you level up your trading game. Got any questions or thoughts? Drop them in the comments below. I'd love to hear from you. Thanks for watching, and remember, the road to successful day trading is all about learning, practicing, and staying disciplined. Happy trading, and I'll see you in the next video.